Good morning, students, and welcome to Chapter 15, the Payables Ledger. First of all, congratulations. You have now completed 14 chapters out of 17 chapters in this course. That is a very strong achievement. You started from the basic foundations of recording financial transactions, and step by step you have built your accounting knowledge. Now you are very close to completing the full syllabus. This chapter is important because it deals with one of the most common and practical areas of accounting, money owed by the business to its suppliers. In earlier chapters, we studied how a business records money owed by customers. That area is called the receivables ledger. Now we move to the other side. When a business buys goods or services on credit, it does not always pay immediately. The suppliers are owed money, and those supplier accounts are recorded in the payables ledger. So, in simple words, the payables ledger contains the personal accounts of suppliers. It shows how much the business owes to each supplier and helps the business control, check, and pay those amounts correctly. In this chapter, we will cover 4 main areas. First, we will study personal accounts for suppliers. You will learn why each supplier needs a separate account and why it is not enough to know only the total amount owed to all suppliers. A business must know exactly how much it owes to each individual supplier. Second, we will study recording transactions in the payables ledger. This means we will learn how purchases, purchase returns, payments, discounts, and balances are entered into supplier accounts. Third, we will study payments to suppliers. We will look at how businesses prepare payments, how they check that payments are accurate and valid, and how they use documents such as remittance advices to explain what is being paid. Fourth, we will study the age analysis of payables and other reports. This is very important for control. It helps the business see which supplier balances are old, which amounts need urgent payment, and whether the business is managing its credit obligations properly. We will also study reconciliation in this chapter. Reconciliation means comparing the business's own supplier account records with the statement received from the supplier. If there is a difference, the business must investigate and correct or explain the discrepancy. By the end of this chapter, you should be able to understand how supplier accounts are maintained, how payments are recorded, how trade payables are controlled, and how businesses check the accuracy of amounts owed to suppliers. This chapter is practical, exam relevant, and very useful in real accounting work. So pay close attention, because the payables ledger is not only a topic for the exam, it is also something accountants use regularly in real businesses. In this lesson, we are starting Lesson 1, Personal Accounts for Suppliers, and then we will explain Lesson 1.1, the need for personal accounts. This lesson is about a very important question. Why does a business need a separate account for each supplier? To understand this properly, let us begin slowly. Lesson 1, Personal Accounts for Suppliers. When a business buys goods or services on credit, it does not pay immediately. For example, a business may buy goods today and agree to pay the supplier next month. In accounting, when the business owes money to a supplier, that supplier is called a payable. A payable means an amount that the business must pay in the future. So, the payables ledger is a record of the suppliers to whom the business owes money. The textbook says that the payables ledger contains the personal accounts of suppliers. Let us explain this in beginner language. A personal account for a supplier is a separate account for one supplier only. For example, imagine a business buys goods from these suppliers. Supplier A, ABC Office Supplies. Supplier B, City Computers. Supplier C, Fresh Packaging Limited. The business should not mix all 3 suppliers together in one confusing record. Instead, the business keeps a separate account for each supplier. So there will be ABC Office Supplies account, City Computers account, Fresh Packaging Limited account. Each account shows how much the business owes to that specific supplier. This is why we call them personal accounts. They are personal to each supplier. Simple meaning of the payables ledger. The payables ledger is like a detailed notebook for suppliers. It answers questions such as, how much do we owe to ABC Office Supplies? How much do we owe to City Computers? Have we already paid Fresh Packaging Limited? Did we receive a credit note from a supplier? Is the balance correct? Is the payment due now or later? So the payables ledger is not just a list of names. It is a control record that helps the business manage supplier debts carefully. Important point. The Trade Payables General Ledger account shows the total amount owed to all credit suppliers. But the Payables Ledger shows the amount owed to each individual supplier. This is very important. Let us make it simple. Suppose a business owes money to 3 suppliers: ABC Office Supplies, $200, City Computers, $500, Fresh Packaging Limited, $300. The total trade payables balance is $200 plus $500 plus $300 equals $1,000. The general ledger may show trade payables equals $1,000, but this total alone is not enough. The business also needs to know ABC Office Supplies equals $200, City Computers equals $500, Fresh Packaging Limited equals $300. That detailed information is kept in the payables ledger. Lesson 1. Point 1. The need for personal accounts. Now we move to Lesson 1.1, the need for personal accounts. The key question is, why does a business need a personal account for each supplier? The answer is because the business must know exactly how much it owes to each supplier. It is not enough to know the total amount owed to all suppliers. The business needs detail. Let us understand why. Reason 1. To check the amount owed to each supplier. A supplier may contact the business and say, "You owe us the full balance. Please pay now." The business cannot simply accept this without checking. The accounting staff must be able to open that supplier's personal account and check what invoices were received, what payments were already made, what credit notes were received, what balance is still outstanding. Is the supplier asking for the correct amount? Is the balance due for payment now? Without a personal account, the business may pay the wrong amount. That could cause serious problems. The business might overpay the supplier. The business might underpay the supplier. The business might pay an amount that is not yet due. The business might pay an invoice twice. The business might damage its relationship with the supplier. So, a separate supplier account helps the business check accuracy before making payment. Reason 2. To compare with supplier statements. Many suppliers send a statement of account every month. A supplier statement is a document sent by the supplier. It shows what the supplier believes the business owes. The business then compares the supplier statement with its own supplier account. This process is called reconciliation. Reconciliation means checking 2 records against each other to make sure they agree. For example, the supplier statement may say amount owed equals $600, but the business's own payables ledger account may say amount owed equals $500. Now there is a difference. The business must investigate why. Maybe the business has not recorded one invoice. Maybe the supplier has not recorded one payment. Maybe a credit note is missing. Maybe there is a timing difference. Maybe one side made an error. Without a personal account for that supplier, this checking would be very difficult. So personal accounts help the business compare its records with supplier statements. Reason 3. To keep a complete record of transactions. A business needs a complete record of all items that make up a supplier balance. A supplier balance may include invoices received from the supplier, payments made to the supplier, purchase returns, credit notes received, discounts allowed by the supplier, balance brought down from the previous month, balance carried down to the next month. This detail is necessary because the final balance is not just one random number. It is built from many transactions. For example, suppose the business owes a supplier $500. The business needs to know how that $500 was created. Was it from one invoice? Was it from several invoices? Was a payment already made? Was a credit note received? Was a discount taken? The personal account gives the full story behind the balance. That is why it is useful. Reason 4. To make payments at the correct time. A business may have many suppliers. Some suppliers may need to be paid this week. Some may need to be paid next month. Some may already have been paid. Some may have balances that are disputed. If the business does not keep separate supplier accounts, it may not know who should be paid and when. This can create problems. If the business pays too early, it may lose cash too soon. If the business pays too late, the supplier may stop supplying goods or services. Late payment can also damage the business's reputation. So, personal supplier accounts help the business plan payments properly. Simple classroom example. Let us imagine a small shop called Bright Stationery Store. Bright Stationery Store buys goods on credit from two suppliers. The first supplier is Paper World. The second supplier is Office Masters. Paper World sends an invoice for $400. Office Masters sends an invoice for $700. The total amount owed to suppliers is $400. Plus $700 equals $1,100. But the business must not only know the total, it must know Paper World equals $400. Office Masters equals $700. Now imagine Bright Stationery Store pays Paper World $200. The balance for Paper World becomes $400 minus $200 equals $200. Office Masters is still $700. So now the total amount owed to suppliers is $200 plus $700 equals $900. If the business only had one total account, it would know that it owes $900, but it might not clearly know who is owed what. The personal accounts solve this problem. They show Paper World equals $200. Office Masters equals $700. That is clear, useful, and controlled. Important exam understanding. For your exam, you should understand the difference between the Payables Ledger and the Trade Payables General Ledger account. The Payables Ledger gives detailed supplier-by-supplier information. The Trade Payables General Ledger account gives the total amount owed to suppliers. The two should agree. If the total of all supplier accounts in the Payables Ledger does not agree with the Trade Payables Control account, then there may be an error. This is why the Payables Ledger is important for control and accuracy. Lesson 1.2. The Payables Ledger. Welcome back, students. Now we are studying Lesson 1.2, the Payables Ledger. In the previous lesson, we learned that the business needs a separate personal account for each supplier. Now, we will learn how those supplier accounts are updated when transactions happen. The main idea of this lesson is simple. When the business records a transaction in the General Ledger, it also updates the individual supplier account in the Payables Ledger. So the General Ledger gives the main accounting record, and the Payables Ledger gives the detailed supplier-by-supplier record. The big idea. Imagine the business buys goods on credit from a supplier called M. Jones. The purchase is for $500. Because the business bought goods on credit, two things happened. First, the business has made a purchase. Second, the business now owes money to M. Jones. So the accounting record is debit purchases with $500, credit trade payables M. Jones with $500. Let us explain this slowly. The debit to purchases records that the business has bought goods, the credit to trade payables records that the business now owes money to the supplier. At the same time, the individual account of M. Jones in the Payables Ledger is updated to show that the business owes M. Jones $500. This is the important point. The General Ledger records the main accounting entry. The Payables Ledger records the detail for the individual supplier. Why do we update the supplier account? The business may have many suppliers. For example, M. Jones Bunter Company, Office Masters Paper World City Computers. The business must know exactly how much it owes to each one. So, when an invoice comes from M. Jones, the M. Jones account is updated. When a payment is made to Bunter Company, the Bunter Company account is updated. When a credit note is received from Office Masters, the Office Masters account is updated. This keeps the Payables Ledger accurate and useful. The supplier account has two sides. A supplier personal account is normally shown like a T account. The left side is the debit side. The right side is the credit side. For supplier accounts, this rule is very important. The credit side usually shows amounts that increase what the business owes. The debit side usually shows amounts that reduce what the business owes. Let us make that even simpler. If the business receives an invoice from a supplier, the business owes more money. So the invoice is recorded on the credit side of the supplier account. If the business pays the supplier, the business owes less money. So the payment is recorded on the debit side of the supplier account. What goes on the credit side? The main item on the credit side is invoices received from suppliers. An invoice received means the supplier is asking the business to pay for goods or services supplied. Because the invoice increases the amount owed to the supplier, it goes on the credit side of the supplier account. Example, the business receives an invoice from M. Jones for $500. This means the business owes M. Jones $500. So, in M. Jones's personal account, the invoice is recorded on the credit side. What goes on the debit side? The debit side records items that reduce the amount owed to the supplier. There are 3 common items. First, payments made to suppliers. When the business pays the supplier, the debt becomes smaller, so the payment goes on the debit side. Second, purchase returns or credit notes received. If the business returns goods to the supplier, or the supplier gives a credit note, the amount owed becomes smaller, so this goes on the debit side. Third, discounts received. Sometimes the supplier gives a discount because the business pays quickly. This is called a settlement discount or prompt payment discount. Because the business now pays less than the full invoice amount, the discount reduces the amount owed, so it goes on the debit side. So remember, invoices received go on the credit side, payments made go on the debit side, purchase returns go on the debit side, credit notes received go on the debit side, discounts received go on the debit side. Simple memory rule. For a supplier account, think like this. Credit means the business owes more. Debit means the business owes less. This is one of the most important rules in this lesson. Example, Bunter Company. Now let us explain the example from the lesson. The supplier is Bunter Company. At the start, the business already owes Bunter Company $200. This is called the balance brought down. Because it is an amount owed to the supplier, it appears on the credit side. So we say, balance brought down equals $200. Then the business receives a new invoice from Bunter Company for $315. This invoice increases the amount owed, so it is recorded on the credit side. Now the total owed before payment is $200 plus $315 equals $515. Then the business pays Bunter Company $150 by bank. A payment reduces the amount owed, so the payment is recorded on the debit side. Now the remaining balance is $515 minus $150 equals $365. So at the end, the business still owes Bunter Company $365. This is called the balance carried down at the end of the period. Then at the beginning of the next period, it becomes the balance brought down. Because the business still owes the supplier, the balance brought down appears on the credit side. Why does the balance carried down appear on the debit side? This part can confuse beginners, so listen carefully. In the Bunter Company account, the credit side is larger because the business owes money to the supplier. To make both sides of the T account equal, the closing balance is placed on the debit side as balance carried down. This is only done to balance the account. Then, when the next period begins, the same balance is brought down on the credit side because it is still a liability. So the debit side balance carried down is just a balancing figure. The real meaning is shown by the next period balance brought down on the credit side. That means the business still owes Bunter Company $365. Now we are studying Lesson 1.3, Debit Balances in the Payables Ledger. In the previous lesson, we learned that a supplier account normally has a credit balance. That is because the business usually owes money to the supplier. But sometimes a supplier account may have a debit balance. This is unusual, but it can happen. So today our main question is, what does a debit balance in the payables ledger mean? Normal situation. Supplier account has a credit balance. Let us begin with the normal rule. A supplier is someone the business owes money to. So in most cases, the supplier account shows a credit balance. A credit balance in a supplier account normally means the business owes money to the supplier. For example, the business receives an invoice from Bunter Company for $300. This increases the amount owed, so the supplier account is credited. The credit balance means the business must pay Bunter Company. That is the normal situation. Unusual situation. Supplier account has a debit balance. Now let us look at the unusual situation. A supplier account may sometimes show a debit balance. A debit balance in a supplier account means the supplier owes money to the business, or the business has paid more than it should have paid. This is not normal because normally the business owes the supplier, not the other way around. So when we see a debit balance in the payables ledger, we should stop and think carefully. It may mean something unusual has happened. Example: overpayment to a supplier. Let us use a simple example. Suppose the business owes Bunter Company $365. Then the business accidentally pays Bunter Company $375. Now let us calculate. $375 minus $365 equals $10. The business has paid $10 too much. So the supplier account will now show a debit balance of $10. This means Bunter Company owes the business $10, or the business has a credit with Bunter Company for $10. In simple words, the business overpaid the supplier. Why is a debit balance unusual? A supplier account is part of the payables ledger. The payables ledger is mainly used to record on amounts owed by the business to suppliers. So the normal balance is a credit balance. A debit balance is unusual because it means the direction has changed. Instead of the business owing the supplier now owes the business, or the supplier must reduce a future invoice. That is why a debit balance should be checked carefully. Common reason 1: overpayment made by error. The first common reason for a debit balance is an overpayment. An overpayment happens when the business pays more than the balance owed. For example, amount owed to supplier equals $400. Amount paid to supplier equals $450. Now the business has paid too much. $450 minus $400 equals $50. So the supplier account may show a debit balance of $50. This means the supplier owes the business $50, or the business may use that $50 against a future purchase. Common reason 2: credit note received after full payment. The second common reason is a credit note received after full payment. Let us understand this carefully. Imagine the business receives an invoice from a supplier for $500. Then the business pays the full $500. At this point, the supplier account balance becomes zero. But later, the supplier sends a credit note for $50. Maybe some goods were returned. Maybe some goods were damaged. Maybe the supplier made an error on the invoice. Maybe the supplier gave an allowance. Now the business has already paid the full amount, but the supplier has reduced the amount owed by $50. So the supplier account may now show a debit balance of $50. This means the supplier owes the business $50, or the business can deduct $50 from a future payment. Simple classroom example. Let us imagine a business called Bright Stationery Store. Bright Stationery Store owes Paper World $200. The accountant accidentally pays Paper World $220. Now the calculation is $220 minus $200 equals $20. The business has overpaid by $20, so Paper World's account will show a debit balance of $20. This means Paper World owes the business $20. The business can deal with this in different ways. Paper World may refund $20. Paper World may reduce the next invoice by $20. The business may leave the amount as a credit against future purchases. What should the business do? When a debit balance appears in the payables ledger, the business should investigate. The accountant should ask, was the supplier overpaid? Was a payment entered twice? Was a credit note received after payment? Was an invoice missing from the account? Was the wrong supplier account used? Was there a posting error? Should the supplier refund the money? Should the balance be used against a future invoice? This is important because a debit balance may show a mistake. If debit balances happen often, it may mean the business has weak payment controls. For example, the business may not be checking supplier balances properly before making payments. Why this matters for control: a debit balance in the payables ledger is not automatically wrong. Sometimes it is correct, but it is unusual. Because it is unusual, the business must check it. This is part of good internal control. Internal control means the procedures used by a business to prevent errors, detect mistakes, and protect money. If the business pays suppliers without checking balances carefully, it may lose cash unnecessarily. So debit balances help the accountant identify possible problems. Important exam understanding. For your exam, remember this clearly. A credit balance in a supplier account normally means the business owes money to the supplier. A debit balance in a supplier account is unusual. A debit balance may happen because the business overpaid the supplier. A credit note was received after the supplier had already been paid in full. If debit balances happen frequently, the business should investigate the cause. This may show that there are errors or weak procedures in the Payables Ledger department. Key terms: debit balance. A debit balance in a supplier account means the account balance is on the debit side. In the Payables Ledger, this usually means the supplier owes money to the business, or the business has paid too much. Overpayment. An overpayment happens when the business pays more than the amount owed. Credit note received. A credit note received is a document from the supplier that reduces the amount the business owes. Investigation. Investigation means checking the records carefully to find out why something unusual has happened. Final summary. In Lesson 1.3, we learned that supplier accounts normally have credit balances because the business normally owes money to suppliers. But sometimes a supplier account may have a debit balance. A debit balance is unusual. It may happen when the business overpays a supplier, or when a credit note is received after the supplier has already been paid in full. The key message is, a credit balance usually means the business owes the supplier. A debit balance in the Payables Ledger usually means the supplier owes the business, or the business has paid too much. Because debit balances are unusual, they should be investigated carefully. Now we are studying Lesson 1.4, Trade Accounts Payable. This lesson is short in the textbook, but it is very important because it helps us understand which supplier balances are part of trade payables. The main question for this lesson is, what are trade accounts payable? Meaning of trade accounts payable. Trade accounts payable are amounts owed to suppliers for goods or services connected with the normal trade of the business. In simple words, a trade account payable is money the business owes to suppliers because those suppliers helped the business carry out its normal business activity. So if a business buys goods or services and does not pay immediately, the amount owed may become a trade payable. What does trade mean? The word trade means the normal activity of the business. For example, if a business is a shop, its trade is buying and selling goods. If a business is a manufacturer, its trade is making products. If a business is a repair company, its trade is providing repair services. So when we say trade accounts payable, we are talking about amounts owed to suppliers that are connected to the business's normal operations. Example 1. A shop. Imagine a clothing shop. The shop buys clothes from a supplier and sells those clothes to customers. If the shop buys clothes on credit, the supplier becomes a trade payable. Why? Because the clothes are part of the shop's normal trading activity. The business buys the clothes so it can sell them. So, the supplier of the clothes is a trade creditor, and the amount owed is a trade account payable. Example 2. A manufacturing business. Now imagine a furniture manufacturing business. This business buys wood, fabric, glue, and metal parts to make furniture. If the business buys these materials on credit, the suppliers become trade payables. Why? Because those materials are used to make the products that the business sells. So the suppliers of raw materials are part of the trade accounts payable. Example 3. Office and service suppliers. Trade payables may also include suppliers of other goods and services used by the business. For example, office supplies, telephone services, electricity services, garage repairs for business vehicles, cleaning services, packaging materials. These suppliers may not provide goods for resale, but they still provide goods or services used in the business. If the business receives these goods or services on credit, the amount owed can be recorded as a trade payable. Important understanding. A trade account payable is a liability. A liability means the business owes money. So, when the business owes money to suppliers, it has a liability. For example, the business buys goods from a supplier for $500 on credit. This means the business has received goods. The business has not paid yet. The business now owes the supplier $500. Therefore, the business has a trade payable of $500. In simple words, goods or services received now. Payment will be made later. Amount owed to supplier equals trade payable. Link with the Payables Ledger. Each trade payable supplier will have a personal account in the payables ledger. For example, a business may owe money to Paperworld City Computers, ABC Packaging, Electricity Company, Office Supplies, Limited. Each supplier has its own account in the payables ledger. The payables ledger shows the detailed balance for each supplier. The total of these supplier balances supports the total trade payables figure in the general ledger. Trade payables and credit transactions. Trade accounts payable usually arise from credit transactions. A credit transaction means the business receives goods or services now but pays later. For example, a supplier sends goods today. The supplier sends an invoice. The business records the invoice. The business pays later. Until payment is made, the amount owed remains in the payables ledger. Simple classroom example. Let us imagine a small bakery. The bakery buys flour from Flour Supply Company. The bakery also receives electricity from the electricity company. The bakery buys packaging boxes from Box World. If the bakery has not yet paid these suppliers, the bakery may have trade accounts payable. So, the bakery's payables ledger may show Flour Supply Company equals $400 owed. Electricity Company equals $150 owed. Box World equals $200 owed. The total trade payables would be $400 plus $150 plus $200 equals $750. This means the bakery owes $750 to trade suppliers. Why trade accounts payable matter? Trade accounts payable matter because they show how much the business owes to suppliers. This helps the business plan payments, avoid late payment, maintain good supplier relationships, check supplier statements, control cash flow, prepare accurate financial statements. If trade payables are not recorded correctly, the business may not know its true liabilities. That means the financial statements may be wrong. Common beginner mistake. A common mistake is thinking that every payable is exactly the same. But in accounting, we often separate different types of payables. Trade payables are connected with normal business trading activities. Other payables may include amounts such as tax payable, wages payable, or other amounts not directly connected with supplier trading accounts. We will study other payables separately later. For now, remember, trade accounts payable are mainly supplier balances connected with the ordinary trade and operations of the business. Now we are studying Lesson 1.5, Other Payables. In the previous lesson, we studied trade accounts payable. Trade accounts payable are amounts owed to suppliers for goods or services connected with the normal trade of the business. Now we move to other payables. The main question for this lesson is, what are other payables, and how are they different from trade accounts payable? The meaning of other payables. Other payables are amounts that the business owes, but they are not usually owed to normal trade suppliers. In simple words, other payables are liabilities that the business must pay, but they are not normally part of the ordinary supplier accounts in the payables ledger. A liability means an amount that the business owes. So both trade payables and other payables are liabilities, but they are different types of liabilities. Trade payables are usually owed to suppliers for normal business goods and services. Other payables are owed for different reasons, such as wages, taxes, or non-current asset purchases. Trade payables compared with other payables. Let us compare them clearly. A trade payable may happen when a clothing shop buys clothes from a clothing supplier on credit. The clothes are part of the normal trade of the business because the shop buys clothes to sell them. So, the amount owed to the clothing supplier is a trade payable. But an other payable may happen when the business owes wages to employees, or tax to the government, or money for a non-current asset. These are still amounts owed, but they are not normal supplier balances for trading goods. That is why they are called other payables. Why other payables may not be in the payables ledger. The payables ledger is mainly used for supplier personal accounts. For example, supplier accounts such as Paperworld, Office Masters, ABC Packaging, Electricity Supplier. But other payables may not be recorded in the payables ledger. They may be recorded in separate general ledger accounts. For example, wages payable account, tax payable account, accruals account, non-current asset supplier account, other creditors account. This makes the accounting records clearer. It helps the business separate normal supplier debts from other types of amounts owed. Example 1. Wages and salaries payable. The first important example of other payables is wages and salaries payable. A business may owe money to its employees. For example, suppose employees work during the month, but the business pays wages at the end of the month or after the month has ended. At the accounting date, the employees have already worked. So the business has already received the benefit of their work. But if the employees have not yet been paid, the business owes them money. That unpaid amount is a payable. It may be called wages payable, salaries payable, accrued wages, accrued salaries. Let us make this simple. Employees work first. The business pays later. Therefore, the business owes the employees. That amount is an other payable. This is not a trade payable because employees are not trade suppliers. They are workers of the business. Example 2, taxes payable. The second important example of other payables is tax payable. Sometimes a business collects tax on behalf of the government. For example, a business may collect sales tax from customers. The business does not keep that tax as its own income. It must later pay that tax to the government. So until the tax is paid to the government, the business has a liability. That liability is a tax payable. Another example is payroll tax, or amounts deducted from employees, wages that must later be paid to the tax authority. The key idea is, the business may hold money temporarily, but the money belongs to the government or another authority. So the business owes that amount. That is why it is recorded as a payable. Example 3. Amounts payable for non-current assets. The third important example is an amount payable for a non-current asset. A non-current asset is an asset used by the business for a long time. Examples include motor vehicles, equipment, machinery, office furniture, computers, buildings. Suppose a business buys a delivery van on credit. The delivery van is not bought for resale in the normal trade of the business. It is bought for long-term use. So, the amount owed for the delivery van is not usually treated as a normal trade payable. It is still a liability, but it may be shown separately as another payable. In simple words, the business has received the asset. The business has not paid yet. The business owes money. Therefore, there is a payable. But because the asset is not part of normal trading goods, it is not treated in the same way as normal trade payables. Add example 4, overhead expenses payable. Some overhead expenses may also create payables. An overhead expense is a general business expense that helps the business operate. Examples include electricity, telephone, internet, cleaning, repairs, office rent, insurance. In some businesses, these may be processed through the payables ledger together with trade suppliers. In other businesses, they may be recorded separately as other payables. The treatment depends on the business's accounting system. The important point is this: some payables are directly related to normal trading goods. Some payables are general expenses or other obligations. The business must record each payable in the correct account. Items that are usually shown separately. The textbook also explains that some special payables are usually shown separately in the statement of financial position. Let us discuss them carefully. Company tax payable. A company may owe company tax on its profit. This is a liability because the company must pay it. But company tax payable is not normally treated as a trade payable. It is usually shown separately because it is a special type of tax liability. So, company tax payable is not mixed with ordinary supplier accounts. Bank loans and bank overdrafts. Bank loans and overdrafts are also liabilities, but they're not normally recorded in the payables ledger. A bank loan is money borrowed from the bank. It is normally recorded in a separate bank loan account. A bank overdraft happens when the business's bank account has a credit balance. This means the business has taken more money out of the bank account than it had available, and it owes money to the bank. These are financing liabilities, not supplier payables. So they should be shown separately from normal trade payables. Important accounting point. All payables normally have a credit balance. Why? Because a credit balance in a liability account usually means the business owes money. For example, trade payables have credit balances. Wages payable has a credit balance. Tax payable has a credit balance. A bank loan has a credit balance. An overdraft usually appears as a credit balance in the bank account. So remember this rule: liabilities normally have credit balances. Simple classroom example. Let us imagine a small bakery called Fresh Bread Bakery. At the end of the month, the bakery has several amounts owed. It owes a flour supplier $800. This is a trade payable because flour is part of the bakery's normal trade. It owes employees $1,200 for wages not yet paid. This is an other payable because employees are not trade suppliers. It owes tax of $300 to the government. This is an other payable because the business must pay the tax authority. It owes $2,000 for a new oven bought on credit. This is an other payable because the oven is a non-current asset. So the bakery has both trade payables and other payables. The flour supplier is a trade payable. The wages, tax, and oven payable are other payables. Why this lesson matters? This lesson matters because financial statements must show liabilities correctly. If a business mixes every payable together without proper classification, the accounts become less clear. Users of financial statements need to understand how much is owed to trade suppliers, how much is owed to employees, how much is owed for taxes, how much is owed to banks, how much is owed for other obligations. Good classification helps the business prepare clearer and more reliable financial statements. Chapter 15, Accounts Payable. This question is testing whether you understand the difference between trade accounts payable, other payables, and capital or equity accounts. Part A, Status of a Trade Account Payable. The question asks, what is the status of a trade account payable in the accounts of a business? The correct answer is option 2, a liability. A trade account payable means the business owes money to a supplier. For example, if a business buys goods from a supplier on credit, the business has received the goods now but will pay later, so the business has an obligation to pay. In accounting, an obligation to pay is called a liability. So a trade account payable is not an asset, not an expense, and not revenue. It is a liability. Part B, Accounts not normally found in a payables ledger of trade accounts payable. Now the question asks, which accounts are not normally found in a payables ledger of trade accounts payable? To answer this, we must first understand the meaning of trade payables. Trade payables are amounts owed to suppliers who provide goods or services needed for the normal trade of the business. So, the accounts that are normally found in the payables ledger are supplier accounts. The accounts that are normally found in the payables ledger are option 2. Personal accounts for suppliers of subcomponents. These suppliers provide parts or materials used in the business, so they are trade suppliers. Option 5. Suppliers of raw materials. Raw materials are used in normal business operations, so these suppliers are trade suppliers. Option 9. Telephone expense. The telephone provider supplies a service used by the business. In this type of question, the textbook treats this as connected with trade payable records. In practice, the supplier account would be recorded, while the telephone expense account itself would be part of the general ledger. Therefore, the accounts not normally found in the trade payables ledger are option 1, proprietor's capital. This is capital or equity, not a trade payable. Option 3, taxation authorities. Tax owed to the government is a payable, but it is not normally a trade payable. Option 4, sales tax authorities. Sales tax owed to the government is also a payable, but it is not normally a trade payable. Option 6, bank overdraft. A bank overdraft is money owed to the bank. It is a liability, but it is not a trade payable. Option 7, long-term bank loan. A bank loan is a financing liability, not a trade payable. Option 8, share premium. Share premium is part of capital or equity, not a payable. Option 10, drawings. Drawings are connected with the owner taking value out of the business. They are part of owner's equity records, not trade payables. Final answer. For Part A, the correct answer is a trade account payable is a liability. For Part B, the accounts not normally found in a payables ledger of trade accounts payable are proprietor's capital, taxation authorities, sales tax authorities, bank overdraft, long-term bank loan, share premium, drawings. The key exam idea is all trade payables are liabilities, but not all liabilities are trade payables. Now we are moving to Lesson 2, recording transactions in the payables ledger, and then we will explain Lesson 2.1, recording purchases and cash paid. In Lesson 1, we learned what supplier accounts are and why each supplier needs a separate personal account. Now we're going one step further. We are asking, when a transaction happens, how is it recorded in the accounting records? Lesson 2, recording transactions in the payables ledger. The payables ledger is used to record transactions with suppliers. When the business buys goods or services on credit, pays a supplier, receives a credit note, or receives a discount, the records must be updated. But there is one very important point. The business does not update only one record. Usually, the business updates the general ledger and the individual supplier account in the payables ledger. Let us explain this carefully. The general ledger and the payables ledger. The general ledger contains the main accounts of the business. For example, purchases account, bank account, trade payables general ledger account, purchase returns account, discounts received account. The payables ledger contains the separate personal accounts of suppliers. For example, M. Jones account, Bunter Company account, ABC Supplies account, Office Masters account. So the general ledger gives the main accounting record. The payables ledger gives the detailed supplier by supplier record. The mirror image idea. The textbook says this process is like a mirror image of the receivables ledger. Let us make this simple. In the receivables ledger, we record customers who owe money to the business. In the payables ledger, we record suppliers whom the business owes money to, so the direction is opposite. Receivables are about money coming into the business from customers. Payables are about money going out of the business to suppliers. That is why the payables ledger is like the mirror image of the receivables ledger. What happens when a supplier document is received? The process normally begins when the business receives a document from a supplier. This document may be a purchase invoice, a credit note. A purchase invoice tells the business that it has bought goods or services and must pay the supplier. A credit note tells the business that the amount owed to the supplier has been reduced. The accounts assistant records the details from the supplier document into the accounting system. When that information is entered, the accounting system may update several records at the same time. This is called a simultaneous update. Simultaneous means happening at the same time. Which records are updated? When supplier transaction details are entered, the system may update the trade payables general ledger account, the purchases account, the bank account if cash is paid, the purchase returns account if goods are returned, the prompt payment discounts account if a discount is received, the individual supplier account in the payables ledger. For now, in Lesson 2.1, we focus mainly on purchases and cash paid. We will study discounts separately later. Lesson 2.1, Recording Purchases and Cash Paid. Now let us focus on recording purchases and cash paid. There are two main situations in this lesson. First, the business buys goods or services from a supplier. Second, the business pays the supplier. Let us study each one slowly. Situation 1. Recording a purchase on credit. A purchase on credit means the business receives goods or services now but pays later. For example, a business buys goods from M. Jones for $500 on credit. This means the business now owes M. Jones $500. So, two things must be recorded. First, the business has made a purchase. Second, the business has a liability to the supplier. The accounting entry is debit purchases with $500, credit trade payables with $500. Now let us explain why. The purchases account is debited because the business has bought goods for resale or for use in trade. The trade payables account is credited because the business now owes money to the supplier. At the same time, the personal account of M. Jones in the payables ledger is updated. The M. Jones account is credited with $500 because the business owes M. Jones more money. For supplier accounts, remember this simple rule. Credit means the business owes more. So when a supplier invoice is received, the supplier account is credited. Why? Because the invoice increases the amount owed to the supplier. Situation 2. Recording cash paid to a supplier. Now imagine that later the business pays M. Jones. Suppose the business pays M. Jones $500 from the bank account. Now the business owes M. Jones less money. The accounting entry is debit trade payables with $500, credit bank with $500. Let us explain this. The trade payables account is debited because the liability is reduced. The business no longer owes that amount to the supplier. The bank account is credited because money has gone out of the bank account. At the same time, the M. Jones personal account in the payables ledger is updated. The M. Jones account is debited with $500 because the payment reduces the amount owed to M. Jones. For supplier accounts, remember, debit means the business owes less. So when the business pays a supplier, the supplier account is debited. Why? Because the payment reduces the amount owed to the supplier. Simple full example. Let us use one complete example. A business buys goods from ABC Supplies for $800 on credit. The entry is debit purchases with $800. Credit trade payables with $800. The ABC Supplies personal account is also credited with $800. This shows that the business owes ABC Supplies $800. Later, the business pays ABC Supplies $300 by bank. The entry is debit trade payables with $300. Credit bank with $300. The ABC Supplies personal account is also debited with $300. Now the remaining balance owed to ABC Supplies is $800 minus $300 equals $500. So the ABC Supplies account now shows that the business still owes $500. Why the individual supplier account is important. The Trade Payables General Ledger account shows the total amount owed to all suppliers, but the individual supplier account shows how much is owed to one supplier. For example, the General Ledger may show total trade payables of $10,000, but the business still needs to know how much is owed to ABC Supplies, how much is owed to M. Jones, how much is owed to Bunter Company, how much is owed to Office Masters. That detail is found in the Payables Ledger. This is why the individual supplier account is updated whenever a transaction happens. Let us connect the logic clearly. When the business receives a purchase invoice, the business owes more. The supplier account is credited. The purchases account is debited. Trade payables increase. When the business pays the supplier, the business owes less. The supplier account is debited. The bank account is credited. Trade payables decrease. Common beginner mistake. A common beginner mistake is to think that only the general ledger is updated. That is not enough. The business must also update the supplier's personal account. Why? Because the business must know exactly how much is owed to each supplier. The general ledger gives the total. The payables ledger gives the detail. Both are needed for good accounting control. Now we are studying Lesson 2.2, Discounts Received. This lesson explains how a business records a discount received from a supplier. A discount received means the supplier allows the business to pay less than the full amount owed. This usually happens when the business pays quickly. This type of discount is often called a settlement discount or a prompt payment discount. 1. What is a discount received? A discount received is a reduction in the amount payable to a supplier. In simple words, the business owes the supplier some money, but the supplier says, if you pay early, you do not need to pay the full amount. You can pay a smaller amount. That reduction is called discount received. For example, the business owes the supplier $400. The supplier gives a 10% discount for early payment. 10% of $400 is $40, so the business pays only $360. The discount received is $40. 2. Why is discount received recorded? A discount received is recorded because it reduces the amount owed to the supplier. Remember our supplier account rule. Credit means the business owes more. Debit means the business owes less. When a supplier gives a discount, the business owes less. So, the trade payables account is debited. The other side of the entry is credited to discounts received. Why? Because discounts received are a benefit to the business. The business has saved money. 3. Accounting entry for discount received. The basic entry is Debit Trade Payables General Ledger account, Credit Discounts Received account. Let us explain this slowly. We debit trade payables because the liability is reduced. We credit discounts received because the business has received a benefit by paying less. So the rule is, when a discount is received from a supplier, debit trade payables, credit discounts received. 4. Important link with the supplier account. The individual supplier account in the payables ledger is also updated at the same time. For example, if the discount is from Quentin Company, then Quentin Company's personal supplier account is updated. If the discount is from W. Honor Soper, then W. Honor Soper's personal supplier account is updated. This is important because the general ledger shows the total accounting entry, but the payables ledger shows the detail for each supplier. 5. The question. Now let us explain the question from the book. Cosmo runs a picture framing business. The question gives us the following information. First, Cosmo has a bank balance of $1,200. This is shown in the bank general ledger account as a debit balance brought forward. Second, on 10 January 20x6, Cosmo purchased $400 worth of glass from Quentin Company. The terms say that Cosmo will receive a 10% discount if payment is made within 3 weeks. Third, on 15 January 20x6, Cosmo purchased paper, card, and frames worth $2,000 from W. Honor Soper. Cosmo will receive a discount of $200 if payment is made by 31 January 20x6. Fourth, Cosmo takes advantage of both settlement discounts and pays both suppliers before 31 January 20x6. The task asks us to prepare Part A, the journal entries in the general ledger. Part B, the trade payables general ledger account for January. 6. Solving the Quentin Company transaction. Cosmo purchased glass from Quentin Company for $400. This is a purchase on credit. So the first entry is debit purchases account with $400. Credit trade payables general ledger account with $400. This records the purchase from Quentin Company. Now Cosmo pays early and receives a 10% discount. 10% of $400 equals $40. So Cosmo does not pay the full $400. Cosmo pays $400 minus $40 equals $360. Now we record the payment. Debit trade payables general ledger account with $360, credit bank account with $360. This shows that Cosmo paid $360 to Quentin Company. Now we record the discount. Debit trade payables general ledger account with $40, credit discounts received account with $40. This shows that the amount owed to Quentin Company was reduced by $40 because of the discount. So Quentin Company is now fully settled. $360 paid plus $40 discount equals $400 cleared. 7. Solving the W. Honor Soper transaction. Cosmo purchased paper, card, and frames from W. Honor Soper for $2,000. This is also a purchase on credit. So the first entry is debit purchases account with $2,000. Credit trade payables general ledger account with $2,000. This records the purchase from W. Honor Soper. The supplier offers a discount of $200 if Cosmo pays by the required date. Cosmo takes the discount. So Cosmo pays $2,000 minus $200 equals $1,800. Now we record the payment. Debit trade payables general ledger account with $1,800. Credit bank account with $1,800. This shows that Cosmo paid $1,800 to W. Honor Soper. Now we record the discount. Debit trade payables general ledger account with $200. Credit discounts received account with $200. This shows that the amount owed to W. Honor Soper was reduced by $200 because of the discount. So W. Honor Soper is now fully settled. $1,800 paid plus $200 discount equals $2,000 cleared. 8. Full journal entries for Part A. Entry 1. Purchase from Quentin Company. Debit purchases account with $400. Credit trade payables general ledger account with $400, being purchases from Quentin Company. Entry 2. Purchase from W. Honor Soper debit purchases account with $2,000. Credit trade payables general ledger account with $2,000, being purchases from W. Honor Soper. Entry 3. Cash payment to Quentin Company. Debit trade payables general ledger account with $360. Credit bank account with $360, being cash payment to Quentin Company. Entry 4. Discount received from Quentin Company. Debit trade payables general ledger account with $40. Credit discounts received account with $40. Narration, being 10% discount received from Quentin Company. Entry 5. Cash payment to W. Honor Soper. Debit trade payables general ledger account with $1,800. Credit bank account with $1,800, being cash payment to W. Honor Soper. Entry 6. Discount received from W. Honor Soper. Debit trade payables general ledger account with $200. Credit discounts received account with $200. Being $200 discount received from W. Honor Soper. 9. Trade payables general ledger account for Part B. Now let us prepare the trade payables general ledger account. Remember, purchases on credit increase trade payables, so they go on the credit side. Payments and discounts reduce trade payables, so they go on the debit side. Debit side. Cash paid to Quentin Company, $360. Discount received from Quentin Company, $40. Cash paid to W. Honor Soper, $1,800. Discount received from W. Honor Soper, $200. Total debit side, $360, plus $40, plus $1,800, plus $200, equals $2,400. Credit side purchases from Quentin Company, $400. Purchases from W. Honor Soper, $2,000. Total credit side, $400 plus $2,000, equals $2,400. So both sides are equal. This means all trade payables created during the month have been fully cleared by payments and discounts. 10. Important exam logic. For the exam, remember this pattern. When the business buys from a supplier on credit, debit purchases, credit trade payables. When the business pays the supplier, debit trade payables, credit bank. When the business receives a discount from the supplier, debit trade payables, credit discounts received. The key idea is payments and discounts both reduce the amount owed to suppliers. That is why both are debited to trade payables. Now we are starting Lesson 3, Payments to Suppliers. In the previous lessons, we learned how supplier transactions are recorded in the payables ledger. We studied purchases, payments, and discounts received. Now we move to a very practical question. How should a business actually manage payments to suppliers? This lesson is not mainly about double entry. It is about control. Control means making sure that payments are correct, authorized, valid, and made at the right time. And main idea of Lesson 3. A business should not pay suppliers randomly. Payments to suppliers should be organized according to the normal procedures of the business. In simple words, the business should have a proper system for paying suppliers. This system should answer questions such as, who prepares the payment? Who checks the payment? Who authorizes the payment? When should the supplier be paid? Which payment method should be used? Is the payment supported by proper documents? Is the amount correct? Has this invoice already been paid? Is there any dispute with the supplier? These questions are important because supplier payments involve cash leaving the business. Whenever money leaves the business, there must be strong control. Why supplier payments need control? Supplier payments need control because mistakes and fraud can happen. For example, a business might accidentally pay the same invoice twice. A business might pay the wrong supplier. A business might pay the wrong amount. A business might pay an invoice that has not been approved. A business might pay for goods that were never received. A business might pay too early and create cash flow problems. A business might pay too late and damage its relationship with the supplier. So, payments to suppliers must be checked carefully before money is sent. Checks before payment. Before a supplier is paid, the business should check that the payment is valid. A valid payment means the payment is genuine, correct, and properly supported. The business may check. Was there a purchase order? Was there a supplier invoice? Were the goods or services actually received? Does the invoice agree with the goods received note? Is the price correct? Is the discount correct? Has the invoice already been paid? Is the supplier account balance correct? Has the payment been authorized? These checks help prevent errors and unauthorized payments. Authorization of payments. Another important word in this lesson is authorization. Authorization means official permission. In a business, the person preparing the payment should not always be the same person who approves the payment. Why? Because separating duties improves control. For example, one employee may prepare the list of payments. Another senior employee or manager may approve the payments. This reduces the risk of mistakes and fraud. In accounting, this is called segregation of duties. That means different people are responsible for different parts of the process. Payment methods may vary. The textbook explains that payment methods can vary. A business may pay suppliers by bank transfer, check, direct debit, standing order, online banking, card payment, cash, although this is less common for larger business payments. The checks needed may be different depending on the payment method. For example, if the business pays by online banking, someone must check the supplier's bank details carefully. If the business pays by check, someone must check the check amount, payee name, and signatures. If the business pays by direct debit, someone must check that the supplier is taking the correct amount. The method may change, but the principle is the same. The business must make sure only valid payments are made. Regular payment runs. The textbook also explains that payments to suppliers are often made on a regular basis. For example, a business may pay suppliers once a month. This is sometimes called a payment run. A payment run means the business prepares and processes a group of supplier payments at one time. This is efficient because the business does not need to process payments every single day. For example, instead of paying one supplier on Monday, another on Tuesday, and another on Wednesday, the business may prepare one approved payment list and pay many suppliers together. This saves time and helps the accounts department work in an organized way. Cash flow and supplier payments. Now let us discuss cash flow. Cash flow means the movement of money into and out of the business. When a business pays suppliers, cash leaves the business. So the business must manage payments carefully. A business usually does not want to pay suppliers too early. Why? Because if the business pays too early, it loses cash sooner than necessary. That cash may be needed for wages, rent, tax, stock, or other expenses. So from a cash flow point of view, the business may prefer to pay near the end of the allowed credit period. Credit period. A credit period is the time allowed by the supplier before payment is due. For example, a supplier may allow 30 days of credit. This means the business can pay within 30 days. If the business pays on day 10, it is paid early. If the business pays on day 30, it has used the full credit period. Using the credit period properly can help the business manage cash flow. But there is an important warning. The business should not pay late without a good reason. Paying on time. Even though the business may want to keep cash for as long as possible, it must still pay suppliers on time. Paying on time is important because suppliers may stop supplying goods or services if they are not paid. Late payment can also damage the business's reputation. A supplier may begin to think, this customer is unreliable. Then the supplier may refuse further credit. The supplier may demand cash before delivery. The supplier may charge late payment fees. The supplier may stop doing business with the company. So the business must balance two things. It should not pay unnecessarily early, but it should not pay late. The best approach is pay suppliers by the due date after proper checks and authorization. When payment is not made on time, sometimes a business may not pay by the due date. This should happen only when there is a proper reason. For example, there may be a dispute. A dispute means there is a disagreement between the business and the supplier. The dispute may be about the price charged, the quantity supplied, goods damaged, goods not received, a missing credit note, a discount not applied, an invoice error, a payment already made but not recorded by the supplier. If there is a dispute, the business should not ignore the supplier. The business should communicate clearly with the supplier. Communication with suppliers. Good communication is very important. If there is a problem with an invoice, the business should contact the supplier and explain the issue. For example, the business may say, "We have received your invoice, but we are checking a difference in the quantity." Or, "We are waiting for a credit note for returned goods." Or, "We believe this invoice has already been paid. Please confirm." This helps maintain a good supplier relationship. It also helps the business continue receiving goods and services while the issue is being resolved. Simple example. Let us imagine a business called Bright Office Supplies. Bright Office Supplies owes Paperworld $500. The supplier gives 30 days of credit. The invoice is correct. The goods were received. The payment is authorized. In this situation, Bright Office Supplies should pay Paperworld by the due date. Now imagine another situation. Paperworld sends an invoice for $500, but Bright Office Supplies received damaged goods worth $100. Now there is a problem. The business should not simply pay the full $500 without checking. It should contact Paperworld and ask for a credit note or correction. This is good control. Why this lesson matters? This lesson matters because paying suppliers is not only an accounting activity, it affects the whole business. Good supplier payment procedures help the business protect cash, avoid paying incorrect invoices, avoid duplicate payments, maintain good supplier relationships, use credit periods properly, keep accurate accounting records, reduce fraud risk, avoid business interruptions. If suppliers are not paid properly, the business may struggle to operate. For example, if a bakery does not pay its flour supplier, the supplier may stop delivering flour. Without flour, the bakery cannot make bread. So, payments to suppliers are connected to the daily survival of the business. Important exam focus. For the exam, remember these points clearly. Payments to suppliers should follow the business's normal procedures. Payments should be checked and authorized. The purpose of checks and authorization is to make sure only valid payments are made. Payment methods may vary, and the necessary checks may depend on the payment method. Payments are often made on a regular basis, such as monthly, for administrative efficiency. A business should manage cash flow by not paying too early, but a business should still pay by the due date. If there is a dispute, the business should communicate with the supplier. Good communication helps maintain supply and allows problems to be resolved. Now we are studying Lesson 3.1, Supplier Statement. In Lesson 3, we learned that payments to suppliers must be controlled, checked, authorized, and made at the correct time. Now we focus on one important document used in that control process, the supplier statement. What is a supplier statement? A supplier statement is a document sent by a supplier to the business. It shows the supplier's record of transactions with the business. In simple words, the supplier statement tells the business, "This is what our records show that you owe us." A supplier usually sends this statement regularly, often every month. The supplier statement may show invoices issued by the supplier, credit notes issued by the supplier, payments received from the business, discounts allowed by the supplier, the final balance owed by the business. So, the supplier statement is like a summary of the account from the supplier's point of view. Why does the supplier send a statement? The supplier sends a statement because it wants to show the customer how much is still unpaid. For example, the supplier may say, "You bought goods from us. You paid some invoices. We gave you a credit note. After all these items, this is the amount still due." This helps both the supplier and the customer keep their records clear. It also reminds the business that payment may be due. Important point for beginners. A supplier statement is not the same as an invoice. An invoice usually records one sale or one supply of goods or services. A supplier statement summarizes many transactions over a period. For example, during 1 month, a business may receive several invoices from the same supplier. It may also make one payment and receive one credit note. Instead of looking at every document separately, the supplier statement summarizes the whole account. So, an invoice is one transaction document. A supplier statement is a summary document. What items appear on a supplier statement? A supplier statement normally includes several important items. Opening balance. The opening balance is the amount already owed at the start of the period. For example, if the business already owed the supplier before the new month began, that amount appears as the opening balance. Invoices. Invoices increase the amount owed. If the supplier sends an invoice, it means the business has bought goods or services and must pay, so invoices usually increase the balance due. Credit notes. Credit notes reduce the amount owed. A credit note may be issued because goods were returned, goods were damaged, or the supplier corrected an overcharge. So credit notes usually reduce the balance due. Payments. Payments also reduce the amount owed. When the business pays the supplier records that payment on the statement. Discounts. Discounts reduce the amount payable. For example, if the business pays early, the supplier may allow a settlement discount. Closing balance. The closing balance is the amount still owed at the end of the statement period. This is the amount the supplier believes the business should pay. Why the supplier statement is important. The supplier statement is important because the business can compare it with its own records. The business has its own supplier account in the Payables Ledger. The supplier also has its own record of the business. These two records should normally agree. For example, the supplier statement may show that the business owes $800. The business's payables ledger account for that supplier should also show $800. If both records agree, that is good. But if the records do not agree, the business must investigate. What does compare mean here? To compare means to check one record against another record. The business compares the supplier statement from the supplier with the supplier's personal account in the payables ledger. This checking process helps the business find mistakes, missing items, or timing differences. This process leads into supplier statement reconciliation, which we will study after this. For now, just understand the purpose. The supplier statement helps the business check whether the supplier balance is correct. Simple example. Let us imagine a business called Bright Office Supplies. Bright Office Supplies buys goods from Paperworld. At the end of the month, Paperworld sends a supplier statement. The statement shows opening balance, $200, new invoice, $500, payment received, $300, credit note, $100. Now let us calculate the closing balance. $200 plus $500 minus $300 minus $100 equals $300. So the supplier statement says Bright Office Supplies owes Paperworld $300. Now, Bright Office Supplies must check its own payables ledger account for Paperworld. If its own account also shows $300, the records agree. If its own account shows a different balance, the difference must be investigated. Supplier statement from the supplier's point of view. This is very important. A supplier statement is prepared from the supplier's point of view, not from the customer's point of view. The supplier sees the business as a customer. So, when the supplier sends an invoice, the supplier is saying, "You owe us more." When the supplier receives a payment, the supplier is saying, "You owe us less." The meaning is still understandable if you think in simple language. Invoices increase what we owe. Payments reduce what we owe. Credit notes reduce what we owe. Discounts reduce what we owe. Why differences may appear. Sometimes the supplier statement and the payables ledger do not agree. This does not always mean fraud or a serious mistake. Differences may happen because of timing. For example, the business may have sent a payment near the end of the month, but the supplier has not recorded it yet. Or the supplier may have sent an invoice, but the business has not received it yet. Differences may also happen because of errors. For example, an invoice may be missing. A payment may be recorded in the wrong supplier account. A credit note may not be recorded. A number may be entered incorrectly. So the supplier statement is useful because it helps identify these problems. Link with payment control supplier statements help the business avoid paying the wrong amount. Before making a payment, the business can check, does the statement agree with our payables ledger? Are all invoices genuine? Have all payments been recorded? Have credit notes been included? Is the final balance correct? Is the amount now due for payment? This supports good internal control. Remember, supplier payments involve cash leaving the business, so the business should check carefully before paying. Common beginner mistake. A common beginner mistake is to treat the supplier statement as automatically correct. This is dangerous. The supplier statement is useful, but the business must still check it. The supplier may have made a mistake. The business may have made a mistake. There may be timing differences. So, the supplier statement should be compared with the business's own records before payment decisions are made. For your exam, remember these points clearly. A supplier statement is usually sent by the supplier, often monthly. It shows invoices, credit notes, payments received, discounts, and the balance due. It is compared with the supplier's personal account in the payables ledger. Any differences should be identified and investigated. Supplier statements are important for checking supplier balances and supporting accurate payments. Now we are studying Lesson 3.1. Point 1. Supplier Statement Reconciliations. In the previous lesson, we learned that a supplier statement is a document sent by the supplier showing what the supplier believes the business owes. Now we go one step further. We ask, how does the business check whether the supplier statement agrees with its own payables ledger account? That checking process is called supplier statement reconciliation. What is supplier statement reconciliation? A supplier statement reconciliation means comparing the supplier statement with the business's own payables ledger account for that supplier. In simple words, the supplier says, "This is what you owe us." The business checks, "Does this agree with our own records?" If both records agree, the balance is likely to be correct. If they do not agree, the business must find the reason for the difference. Why do we reconcile supplier statements? A business reconciles supplier statements to make sure the amount owed is correct before payment is made. This is important because the business does not want to pay the wrong amount, pay the same invoice twice, miss an invoice, ignore a credit note, pay a supplier before checking a dispute, record a payment in the wrong supplier account. Remember, payments to suppliers involve cash leaving the business, so the business must check carefully before paying. The main idea. The business compares two records. 1. The supplier statement. This comes from the supplier. 2. The supplier's personal account in the payables ledger. This is the business's own record. The goal is to make sure both records support the same final balance. Step 1. Tick off matching items. The first step is to tick off the items that appear in both records. This means we compare the supplier statement with the payables ledger account line by line. We look for the same: invoices, credit notes, payments, discounts, amounts, dates, reference numbers. When the same item appears in both records, we tick it. A tick means this item agrees. It appears in both records. For example, if invoice number 33004 appears on the supplier statement and also appears in the payables ledger, we tick it in both places. This helps us separate the items that agree from the items that need investigation. Step 2. Agree the opening balance. The second step is to agree the opening balance on the supplier statement. The opening balance is the amount brought forward from the previous period. For example, the statement may begin with a balance brought forward. This balance may be made up of older, unpaid invoices from the previous month. The business must check that this opening balance agrees with its own records. Why is this important? Because if the opening balance is wrong, the final balance will probably also be wrong. So, before checking the new month's transactions, we must make sure the starting balance is correct. Step 3. Allocate payments to invoices after allowing for credit notes. The third step is to allocate payments to invoices after allowing for credit notes. This means we match each payment with the invoice or invoices it was meant to pay. Let us explain this carefully. A business may pay one supplier for several invoices at the same time. For example, one payment may cover 3 different invoices. But before deciding which invoices are paid, we must also consider any credit notes. A credit note reduces the amount owed. So the correct order is: first, identify the invoices. Second, deduct any credit notes that relate to those invoices. Third, match the payment to the remaining amount. This is called allocating payments. In simple words, we are asking, which invoice did this payment clear? This step is important because a payment may not always match one invoice exactly. It may pay several invoices. It may pay part of an invoice. It may pay an invoice after a credit note has reduced it. It may include a discount, so the accountant must check carefully. Step 4. Identify differences. The fourth step is to identify differences. After ticking matching items, checking the opening balance, and allocating payments, any unticked items must be examined. An unticked item means this item appears in one record, but not in the other record. These differences may happen for different reasons. For example, the supplier statement may show an invoice that the business has not recorded yet. The payables ledger may show a payment that the supplier has not recorded yet. The supplier may have issued a credit note, but the business has not received it. The business may have recorded a payment in the wrong supplier account. The supplier may have made an error. The business may have made an error. So, differences do not always mean something is wrong, but they must be investigated. Timing differences. Some differences happen because of timing. A timing difference means the transaction is correct, but it has been recorded by one side before the other side. For example, the business may send a payment at the end of the month. The business records the payment immediately, but the supplier may not record it until the next month. So the payment appears in the business's payables ledger, but not yet on the supplier statement. That is a timing difference. Timing differences are common. They are not necessarily errors, but they must be understood and explained. Errors and omissions. Other differences may happen because of errors or omissions. An error means something was recorded incorrectly. An omission means something was not recorded at all. For example, an invoice may be missing from the payables ledger. A credit note may be missing from the supplier statement. A payment may be entered twice. A payment may be posted to the wrong supplier. An amount may be entered incorrectly. A reference number may be recorded wrongly. These differences must be corrected. Simple classroom example. Let us imagine a business receives a supplier statement from Paperworld. The statement shows Invoice 1, Invoice 2, Payment Received, Credit Note, Closing Balance. The business compares this statement with its own Paperworld account in the Payables Ledger. Invoice 1 appears in both records, so we tick it. Invoice 2 appears in both records, so we tick it. The credit note appears in both records, so we tick it. But the payment appears in the business's payables ledger and not on the supplier statement. Now we ask, did the supplier receive the payment after the statement date? Was the payment sent too late to appear on the statement? Was the payment posted to the wrong supplier by the supplier? Was the payment recorded incorrectly by the business? This is how reconciliation helps us find and explain differences. Why this is a control procedure. Supplier statement reconciliation is a control procedure. A control procedure is a check used by the business to reduce mistakes and protect money. Supplier statement reconciliation helps the business check supplier balances, find missing invoices, find missing credit notes, find unrecorded payments, avoid overpayment, avoid duplicate payment, keep supplier accounts accurate, support correct payments. This is why reconciliation is important in real accounting work. Now we are studying Lesson 3.1.2, Example, Supplier Reconciliation. In the previous lesson, we learned the 4 steps of supplier statement reconciliation. Now we will apply those steps to a real example from the textbook. The main question is, how do we reconcile a supplier statement with the payables ledger account when the two balances do not agree? The situation. The business is called Finstar Company. The supplier is called Pickett Handling Equipment Company. Finstar has its own record for Pickett in the payables ledger. Pickett also sends Finstar a supplier statement. Now there is a problem. The balance in Finstar's payables ledger does not agree with the balance on Pickett's supplier statement. Finstar's payables ledger says the amount owed is $337.31. Pickett's supplier statement says the amount owed is $847.86. These two balances are different. So Blake, the payables ledger clerk, must perform a supplier statement reconciliation. What is the purpose of this reconciliation? The purpose is not to guess. The purpose is to find out why the two balances are different. The supplier statement says one amount. The business's own payables ledger says another amount. So Blake must compare both records carefully and explain the difference. This is important because Finstar should not pay Pickett until it understands the correct balance. Now step 1, tick off matching items. The first step is to tick off the items that appear on both records. Blake compares the supplier statement from Pickett with the payables ledger account in Finstar's accounting records. If the same invoice, payment, or credit note appears in both records, Blake ticks it. A tick means this item agrees. It appears in both records. For example, if invoice number 34207 appears on both the supplier statement and the payables ledger, it is ticked. If credit note number 00192 appears on both records, it is ticked. This helps Blake separate the items that agree from the items that do not agree. Step 2. Agree the opening balance. The next step is to agree the opening balance. The opening balance on the supplier statement is made up of older unpaid invoices. In this example, the opening balance is made up of 3 invoices. Invoice number 3, 3004. Invoice number 3, 3060. Invoice number 34114. These invoices together make the opening balance on Pickett's statement. Blake must check whether these old invoices are also shown in Finstar's payables ledger. This step is important because if the opening balance is wrong, the closing balance may also be wrong. Step 3. Allocate payments to invoices. Now Blake checks which invoices were cleared by payments. The textbook explains that invoice number 33004 and invoice number 33060 were paid on 4 May. Invoice number 34114 was part of the payment made on 28 May. This means Blake must match the payments to the correct invoices. This process is called allocating payments. In simple words, Blake asks, which invoices did this payment pay? This matters because one payment may cover more than one invoice. A payment may also pay part of an invoice. So Blake must carefully match payments against invoices. Step 4. Identify the differences. After Blake ticks matching items and allocates payments, some differences remain. There are 2 main differences in this example. Difference 1. Payment not shown on the supplier statement. Finstar's Payables Ledger shows a payment made on 28 May. The payment amount is $117.77. But Pickett's supplier statement does not show this payment. Why might this happen? This is probably a timing difference. A timing difference means one side has recorded the transaction, but the other side has not recorded it yet. In this case, Finstar may have sent the payment close to the statement date. Pickett may not have processed it before preparing the statement. So Pickett's statement is higher because it does not yet include the payment. Therefore, in the reconciliation, we subtract this payment from the supplier statement balance. Difference 2. Invoice on the supplier statement, but not in the payables ledger. Pickett's supplier statement shows invoice number 34392. The amount is $392.78. But this invoice is not shown in Finstar's payables ledger. This needs investigation. There are 2 possibilities. First, Finstar received the invoice but recorded it in the wrong supplier account. Second, Finstar did not receive the invoice at all. Blake must check the records. If the invoice was received and belongs to Pickett, then Finstar must record it correctly. If the invoice was not received, Blake should contact Pickett and ask for a copy of the invoice. This is important because the invoice may be genuine, but Finstar cannot simply accept it without checking. The reconciliation. Now we reconcile from Pickett's supplier statement balance to Finstar's payables ledger balance. We start with the balance on the supplier statement, $847.86. Then we subtract the payment made on 28 May that is not shown on the supplier statement, minus $117.77. Then we subtract invoice number 34392, which is shown on the supplier statement but not shown in Finstar's payables ledger, minus $392.78. Now the balance becomes $337.31. This agrees with Finstar's payables ledger balance, so the reconciliation proves that the difference has been explained. Why do we subtract these items? This part is very important for beginners. We start with Pickett's supplier statement balance because that is the supplier's balance. Then we adjust it to match Finstar's own payables ledger. The payment is subtracted because Pickett has not included it yet. If Pickett had included the payment, the supplier statement balance would be lower. The invoice is subtracted because Finstar has not recorded it in its payables ledger. If we want to arrive at Finstar's current ledger balance, we must remove the item that appears only on Pickett's statement. So after both adjustments, the supplier statement balance agrees with the payables ledger balance. What should Blake do next? Blake should not stop after preparing the reconciliation. Blake must also follow up on the differences. For the missing payment, Blake should check whether the payment was sent correctly and whether Pickett has received it. For the missing invoice, Blake should check whether Finstar received invoice number 34392. If the invoice was received, Blake should check whether it was posted to the wrong account. If the invoice was not received, Blake should contact Pickett and ask for a duplicate invoice. This is how reconciliation becomes a useful control procedure. Exam focus. For your exam, remember these points clearly. A supplier reconciliation explains why the supplier statement balance and the payables ledger balance are different. A payment recorded by the business but not yet shown by the supplier is usually a timing difference. An invoice shown by the supplier but missing from the payables ledger may be an omission or an error. The accountant must investigate missing items before making payment. The final reconciliation should show how one balance can be adjusted to agree with the other balance. Now we are studying Lesson 3.1.3, the reasons for reconciling items. In the previous lesson, we learned how to compare a supplier statement with the Payables Ledger account. We also learned that sometimes the two balances do not agree. Now we ask an important question. Why do differences happen between the supplier statement and the business's payables ledger? These differences are called reconciling items. A reconciling item is an item that explains why two accounting records do not agree at first. In this lesson, we will study the main reasons for these differences. The main idea. When the supplier statement balance and the payables ledger balance are different, the accountant should not panic. The difference may be caused by payments in transit, omitted invoices or credit notes. Other errors. Some differences are only timing differences. Some differences are real errors. Some differences are omissions, meaning something has been left out. The accountant's job is to identify the reason and then decide whether the item needs correcting, explaining, or following up. 1. Payments in transit. The first reason for a reconciling item is payments in transit. A payment in transit means the business has sent the payment, but the supplier has not yet recorded it. Let us make this simple. Imagine the business pays the supplier by check or bank transfer near the end of the month. The business records the payment immediately in its own payables ledger. But the supplier may not receive the money or process the payment until after the statement is prepared. So, the business's records show the payment, but the supplier statement does not show the payment yet. This causes a difference. Simple example of payment in transit. Suppose the business owes a supplier $1,000. The business sends a payment of $200 on the last day of the month. The business records the payment immediately. So the business's payables ledger says amount owed equals $800. But the supplier statement was prepared before the supplier recorded the payment. So the supplier statement still says amount owed equals $1,000. The difference is $200. This is not necessarily an error. It is probably a timing difference. The payment is on the way, but it has not yet appeared in the supplier's records. Status of payments in transit. The status of this item is usually timing difference. A timing difference means the item is correct, but one side has recorded it earlier than the other side. The accountant should still check it, but it may not require a correction. The accountant should confirm that the payment was actually made and that it was sent to the correct supplier. 2. Omitted invoices and credit notes. The second reason for a reconciling item is omitted invoices and credit notes. The word omitted means left out. So, an omitted invoice means an invoice is missing from one set of records. An omitted credit note means a credit note is missing from one set of records. This can happen in two directions. The supplier statement may show an invoice that the business has not recorded, or the business's payables ledger may show a credit note that the supplier statement does not show. Omitted invoice. An invoice increases the amount owed to the supplier. If the supplier has recorded the invoice, but the business has not recorded it, the supplier statement balance will be higher than the business's payables ledger balance. For example, the supplier statement includes an invoice for $300, but the business's payables ledger does not include it. Now the supplier says the business owes $300 more than the business's own records show. This may mean the invoice was not received by the business, or the invoice was received but entered in the wrong supplier account, or the invoice was received but not entered at all. This must be investigated. Omitted credit note. A credit note reduces the amount owed to the supplier. If the business has recorded a credit note, but the supplier statement does not show it, the supplier statement balance may be higher than expected. For example, the business returned damaged goods. The business recorded a credit note of $100, but the supplier statement does not show that credit note. Now, the supplier statement shows the business owing too much. The accountant must check whether the supplier issued the credit note, whether the business recorded it correctly, and whether the supplier needs to correct the statement. Status of omitted invoices and credit notes. The status of omitted invoices and credit notes may be error omission, or timing difference. It depends on the situation. If the document was simply recorded by one side later than the other side, it is a timing difference. If the item was completely missed, it is an omission. If the item was recorded incorrectly, it is an error, so the accountant must investigate before deciding. 3. Other errors. The third reason for reconciling items is other errors. An error means something has been recorded wrongly. This can happen in the supplier's records or in the business's records. Examples of errors include an invoice entered with the wrong amount, a payment posted to the wrong supplier account, a credit note entered twice, a payment entered twice, an invoice recorded as a credit note recorded as an invoice, a number typed incorrectly, a transaction recorded on the wrong date, a transaction completely missed. These errors can make the supplier statement and payables ledger disagree. Simple example of an error. Suppose the supplier sends an invoice for $500. The business accidentally records it as $50. Now, the business's records are lower by $450. The supplier statement will not agree with the business's payables ledger. This is not just a timing difference. This is an error. The business must correct it. Manual records and errors. Errors are more likely when records are prepared manually. Manual means entered by people without full computer checking. For example, an accountant may copy an amount incorrectly, miss a line, or put the entry into the wrong account. Even in computerized systems, errors can still happen if the original data is entered wrongly. That is why reconciliation is important. It helps find mistakes before payment is made. Why these reconciling items matter. Reconciling items matter because they help the business avoid wrong payments. If the business does not investigate differences, it may pay too much, pay too little, pay the wrong supplier, pay an invoice twice, miss a valid invoice, ignore a credit note, damage the supplier relationship, keep inaccurate accounting records. So, reconciliation protects both the business's cash and the accuracy of the accounting records. Important difference: timing difference versus error. Students, this is very important. A timing difference is not necessarily wrong. It simply means one side recorded the item before the other side. For example, a payment may have been sent but not yet recorded by the supplier. An error means something is wrong and needs correction. For example, an invoice was entered with the wrong amount. An omission means something was left out and may need to be recorded. For example, an invoice is missing from the payables ledger. In the exam, you must understand the difference. Do not treat every difference as an error. First, identify the reason, then decide what action is needed. Simple classroom example. Let us imagine a business called Bright Office Supplies. The supplier sends a statement showing a balance of $1,000. But Bright Office Supplies' payables ledger shows $800. There is a difference of $200. Now the accountant investigates. The accountant finds that Bright Office Supplies sent a payment of $200 yesterday. The business recorded the payment, but the supplier statement was prepared before the supplier recorded it. So the difference is explained. This is a payment in transit. The status is a timing difference. Now imagine a different situation. The supplier statement includes an invoice for $200, but Bright Office Supplies has no record of that invoice. Now the accountant must investigate. Maybe the invoice was never received. Maybe it was posted to the wrong supplier account. Maybe it was missed. This could be an omission or an error. The accountant must not pay blindly. The accountant must check first. Exam focus. For your exam, remember the three main reasons for reconciling items. First, payments in transit. These are usually timing differences. Second, omitted invoices and credit notes. These may be errors, omissions, or timing differences. Third, other errors. These are mistakes in recording and must be corrected. Also remember, a supplier statement reconciliation is not just about finding differences. It is about explaining the differences and deciding whether they need correction or follow-up. Now we are studying Lesson 3.2, Methods of Payment. In the previous lesson, we studied supplier statements and how the business checks the supplier's balance before payment. Now we move to a practical question. How can a business actually pay its suppliers? A business can use different payment methods. The main methods in this lesson are cash, check, interbank transfer. The important point is this: Different payment methods may be used, but the business must still make sure that the payment is correct, authorized, and recorded properly. The main idea of Lesson 3.2: when a business owes money to a supplier, it must eventually settle that amount. To settle a supplier account means to pay the amount owed. For example, if the business owes a supplier $500 and then pays $500, the supplier account has been settled. But businesses do not always pay suppliers in the same way. The method depends on the size of the payment, the business's payment system, the supplier's preference, the level of control needed, the speed and convenience of the method. Method 1. Cash. The first method is cash. Cash means physical money, such as notes and coins. In business, paying suppliers by cash is usually unusual. Why? Because supplier payments are often large, and cash is harder to control. Cash can be lost. Cash can be stolen. Cash is harder to trace. Cash payments may not leave a strong electronic record, so businesses normally avoid using cash for regular supplier payments. However, cash may still be used for very small payments. These small payments are often called petty cash payments. What is petty cash? Petty cash is a small amount of cash kept by the business for minor expenses. For example, buying stamps, buying small office items, paying for minor travel costs, buying tea, milk, or small staff supplies, paying a small local supplier immediately. These are not usually large supplier payments. They are small, everyday payments. So the exam point is, cash is not normally used for paying major suppliers, but it may be used for small petty cash purchases. Method 2. Check. The second method is check. A check is a written instruction to the bank to pay money to another person or business. In the past, many supplier payments were made by check. A business would prepare a check, write the supplier's name, write the amount, have it signed by authorized people, and then send it to the supplier. Historically, checks were very common. But today, check payments are becoming less common because many businesses now use online banking and electronic payments. Why checks are less common? Now, checks can be slower. They may need to be printed or written. They may need to be signed. They may need to be posted. The supplier may need to deposit the check. The bank may take time to clear it. Because of this, many businesses prefer electronic payments. But checks are still important to understand because they may appear in accounting examples and exams. Control point for checks. Even though detailed payment checks are studied more fully later, we should understand the basic control idea. A check should be authorized before it is sent. The business should check. Is the supplier correct? Is the amount correct? Has the invoice been approved? Has the check been signed by an authorized person? This is important because once a check is processed, money will leave the business. Method 3. Interbank transfer. The third method is interbank transfer. An interbank transfer means money is transferred electronically from the business's bank account to the supplier's bank account. This is now a very common method of paying suppliers. It may happen through online banking, electronic funds transfer, automated credit systems, direct bank payment systems. In simple words, the business sends money directly from its bank account to the supplier's bank account. Why interbank transfer is common? Interbank transfer is common because it is faster and more efficient than checks. It can save administrative time. The business does not need to write individual checks. The business does not need to post checks to suppliers. The money can be sent electronically. Many suppliers can be paid through the banking system. There may be lower bank charges compared with check processing. This is why many modern businesses use interbank transfers for supplier payments. Important control point for interbank transfers. Interbank transfer is convenient, but it must be controlled carefully. The business must check supplier bank details. If the wrong bank account is entered, the money may go to the wrong place. So the accounts department should check supplier name, supplier bank account details, payment amount, invoice reference, authorization approval. Again, the payment method changes, but the need for control does not change. Comparing the three methods. Let us compare them in simple language. Cash is usually used only for small payments. It is not common for major supplier payments. Check was common in the past, but it is becoming less common because electronic banking is faster. Interbank transfer is now increasingly common because money can move electronically from one bank account to another. So, from old to modern, the movement is cash for very small payments, checks for traditional business payments, interbank transfers for modern supplier payments. Simple classroom example. Imagine a business called Bright Office Supplies. Bright Office Supplies owes 3 suppliers. It owes a local shop $10 for small office items. This might be paid by petty cash. It owes Paperworld $500. In the past, this might have been paid by check. It owes City Computers $2,000. Today, this would probably be paid by interbank transfer. So, the payment method depends on the nature and size of the payment. Why this lesson matters. This lesson matters because accountants must understand how supplier payments are made. When a payment is recorded in the accounting system, the accountant must know what document or evidence supports it. For cash, there may be a petty cash voucher or receipt. For check, there may be a check number and payment record. For interbank transfer, there may be a bank confirmation or electronic payment reference. Good accounting is not just about recording numbers. It is also about understanding the documents and controls behind the numbers. Now we are studying Lesson 3.3, Selecting Items for Payment. In the previous lesson, we studied different methods of payment, such as cash, check, and interbank transfer. Now we move to another important question. Which supplier invoices should the business pay now, and which should wait? This is called selecting items for payment. Main idea of Lesson 3. Point 3. A business may have many supplier invoices waiting to be paid, but the business should not pay everything randomly. It must decide carefully which suppliers should be paid now, which invoices are due for payment, which invoices are not yet due, which invoices are in dispute, which invoices may receive an early payment discount, which payments should be delayed until the full credit period has been used. This decision is important because it affects the business's cash flow. Management decision. The textbook makes an important point. Deciding when to pay and who to pay is a key function of business management. This means payment selection is not just a simple clerical task. It is a management decision because cash is leaving the business. Usually, a senior person should decide or approve which payments are made. Why? Because paying suppliers affects cash available in the bank, supplier relationships, credit terms, discount opportunities, business reputation, internal control. So a junior clerk may prepare the payment list, but a senior person should review or approve it. Why not pay every invoice immediately? Students, this is very important. A business does not usually pay every invoice as soon as it arrives. Why? Because suppliers often give a credit period. A credit period means the supplier allows the business some time before payment is due. For example, a supplier may allow 30 days of credit. If the business pays immediately, it loses cash earlier than necessary. That cash could be used for wages, rent, stock, tax, or other business needs. So it may be better to use the full credit period as long as the business does not pay late. The aim is pay on time, but not unnecessarily early. Manual selection of payments. In some businesses, items for payment may be selected manually. Manual selection means a person looks through the supplier accounts and decides which invoices should be paid. The person may check invoice dates, payment due dates, supplier terms, discount terms, disputed invoices, supplier balances, cash available in the bank. For example, the accounts clerk may prepare a list of invoices due for payment this week. Then the manager reviews the list and approves the payments. This can work well in a small business, but it can be slow and risky if there are many suppliers. Computerized payables ledger system. In a computerized accounting system, the system may produce a suggested payments listing. A suggested payments listing is a report that suggests which suppliers should be paid, how much should be paid, which invoices are due, which discounts may be available, which payments are not yet due. The computer uses information already stored in the system. For example, supplier payment terms, invoice dates, settlement dates, discount conditions, supplier balances. This helps the accounts department save time. But there is a very important point. The computer's suggested payments list must still be checked by a person. The computer can suggest, but management must still control the decision. Why the suggested payments list must be checked. A computer system may not know every business situation. For example, the computer may suggest paying an invoice, but there may be a problem with that invoice. Maybe the goods were damaged. Maybe the quantity was wrong. Maybe the supplier charged the wrong price. Maybe a credit note is expected. Maybe the invoice is under investigation. Maybe the business does not have enough cash today. Maybe the manager wants to delay payment for a valid reason. So the suggested payment list is useful, but it is not final until it has been reviewed and authorized. Invoices in dispute. Now let us discuss a very important idea. Invoices in dispute. An invoice is in dispute when the business and the supplier have not yet agreed that the invoice is correct. For example, the supplier may send an invoice for $1,000, but the business believes the correct amount should be $800. Or the supplier may charge for goods that were not received, or the goods may have arrived damaged. In these cases, the invoice should not be paid until the dispute is resolved. Procedure for disputed invoices. The business must have procedures to make sure disputed invoices are not paid by mistake. In a manual system, the invoice may be marked clearly as in dispute. In a computerized system, the item may be flagged. To flag an item means to mark it in the system so that it receives special attention. The system may stop that invoice from appearing on the normal payment list. This is useful because it prevents the business from paying an invoice that is still being questioned. Example of an invoice in dispute. Imagine a business receives an invoice from Paperworld for $500, but the business only received goods worth $400. Now there is a difference of $100. The business should contact Paperworld and ask for an explanation or a credit note. Until the issue is settled, the invoice should be marked as in dispute. It should not be paid in the normal payment run. Once the supplier corrects the invoice or issues a credit note, the dispute can be released. Then the invoice can be paid in the normal way. Releasing the dispute. When a dispute is resolved, the item should no longer remain blocked. The accountant or authorized person must update the system. This is sometimes called releasing the dispute. This means the invoice is no longer stopped from payment. For example, the supplier sends the missing credit note. The supplier corrects the invoice. The manager approves the amount. The dispute is removed from the system. The invoice can now appear on the payment list. This is important because if a resolved invoice remains marked as disputed, it may not be paid on time. That could damage the supplier relationship. Taking the full credit period. The textbook also explains that it may be desirable to take the full period of credit from each supplier. Let us explain this in simple language. If a supplier gives 30 days to pay, the business may choose to pay close to the 30th day instead of paying immediately. This helps the business keep cash for longer, but the business must not abuse this. It should still pay by the due date. The aim is not to delay unfairly. The aim is to manage cash flow professionally. How a computer system helps with credit periods. A computerized payables ledger can record the number of days before payment is due for each supplier. For example, Supplier A may allow 30 days. Supplier B may allow 60 days. Supplier C may allow 14 days. The system can use this information to decide which invoices are now due for payment. A computerized system may automatically list items that have reached their settlement date. A settlement date means the date when payment should be made, so the system can help identify payments that are due now. Items excluded from automatic payment lists. A computerized system may exclude certain items from the automatic payment list. Two important examples are items that have not reached their settlement date, items that are in dispute. Let us explain both. If an invoice has not reached its settlement date, it is not yet due, so the system may leave it out of the payment list. If an invoice is in dispute, it should not be paid until the issue is resolved, so the system may also leave it out of the payment list. This helps the business avoid paying too early and avoid paying incorrect invoices. Simple classroom example. Let us imagine a business called Bright Office Supplies. It has 3 supplier invoices. Invoice 1 is due today and has no problem. This invoice can be selected for payment. Invoice 2 is due in 20 days. This invoice should normally wait because it has not reached the settlement date. Invoice 3 is due today, but the goods were damaged and the business is waiting for a credit note. This invoice should be marked as in dispute and should not be paid yet. So only invoice 1 should be selected for payment today. This is good payment control. Now we are studying lesson 3.4, computer checks and remittance advices. In the previous lesson, we studied how a business selects items for payment. That means the business decides which supplier invoices should be paid now. Now we move to the next step. After the business decides what to pay, how can the payment document be produced and explained to the supplier? This lesson focuses on two important things: computer checks, remittance advices. Main idea of lesson 3.4. A computerized payables ledger system can help the business prepare payments to suppliers. In some systems, the computer can print checks for supplier payments. The system can also produce a remittance advice. A remittance advice is a document sent to the supplier to explain what the payment is for. So the main idea is the check sends the money. The remittance advice explains the payment. 1. Computer checks. A computer check is a check printed by a computerized accounting system. In the past, businesses often wrote checks by hand, but in a computerized system, the payables ledger may already know the supplier's name, the supplier's account number, the invoices being paid, the amount to pay, the date of payment, any credit notes or discounts included. So the system can use this information to print a check. This saves time and reduces manual writing. Why computer checks are useful? Computer checks can be useful because they make the payment process more efficient. The business does not need to write every check by hand. The computer can print many checks during a payment run. This is useful when a business has many suppliers. For example, a large business may pay many suppliers at the end of the month. Instead of writing each check separately, the system can produce the checks from the approved payment list. This saves time and helps the accounts department work in an organized way. Special check stationery. The textbook explains that special check stationery will be needed. Stationery means the physical paper used for the check. A computer cannot normally print a check on ordinary blank paper. The business needs official check stationery that the bank will accept. This stationery may already contain bank details, check layout, security features, and space for signatures. So, if a computerized payables ledger system prints checks, it must use the correct check stationery. This is important because checks are payment documents. They must be secure and controlled. Important control point. Even if checks are printed by computer, the business still needs control. The computer may print the check, but the payment must still be checked and authorized. The business should make sure the supplier is correct, the amount is correct, the invoices are valid, the payment has been approved, the check stationery is kept securely, the check is signed only by authorized people. This is important because a check can cause money to leave the business. So computer printing does not remove the need for careful checking. 2. Remittance advice. Now let us move to remittance advice. A remittance advice is a document sent to a supplier with a payment. It tells the supplier what the payment is for. In simple words, the business is saying, "We are sending you this payment, and here is the list of invoices and credit notes included in it." This helps the supplier record the payment correctly. Why a remittance advice is needed. A supplier may receive a payment, but the supplier also needs to know which invoices the payment is settling. For example, imagine the supplier receives a payment of $640.80. Without a remittance advice, the supplier may not know which invoices are being paid, whether a credit note has been deducted, whether a discount has been taken, which customer account the payment belongs to, which reference number should be used. The remittance advice gives this information clearly. What appears on a remittance advice? A remittance advice normally includes important details such as the supplier's name and address, the customer's name and address, the account number, the payment date, the payment reference, invoice numbers being paid, credit note numbers being deducted, the individual amounts, the total payment enclosed or transferred. This allows the supplier to match the payment to the correct account. Important difference. Check and remittance advice. Students, do not confuse these two things. A check is a payment instruction. It tells the bank to pay money. A remittance advice is an explanation document. It tells the supplier what the payment is for. So remember, check means payment, Remittance advice means explanation of payment. Simple example. Let us imagine a business called Bright Office Supplies. Bright Office Supplies owes Paperworld for 2 invoices. Invoice 1 equals $400. Invoice 2 equals $300. Paperworld also issued a credit note for $100. Now the amount to pay is $400 plus $300 minus $100 equals $600. Bright Office Supplies sends a payment of $600. With the payment, it sends a remittance advice showing Invoice 1, $400. Invoice 2, $300. Less credit note, $100. Payment made, $600. Now, Paperworld understands exactly what the payment covers. Example, based on the book layout, the book shows a remittance advice with invoice amounts and a credit note. The idea is that the payment is not just one unexplained amount. The remittance advice breaks the payment down. For example, it may show one invoice included in the payment, another invoice included in the payment, a credit note deducted from the payment, the final payment enclosed. So the supplier can see how the final payment amount was calculated. This helps avoid confusion. Why this is useful for the supplier. The supplier receives many payments from many customers. If the supplier receives a payment without explanation, it may be difficult to match that payment to the correct invoices. The remittance advice helps the supplier identify the customer, identify the invoices paid, identify any credit notes deducted, update the customer account, avoid asking unnecessary questions, reduce errors in recording receipts. So the remittance advice helps both sides. It helps the paying business explain the payment, and it helps the supplier record the payment correctly. Why this is useful for the business. The remittance advice is also useful for the business making the payment. It provides evidence of what the payment was intended to settle. If there is a query later, the business can check the remittance advice and see exactly which invoices were included. For example, if the supplier says, "You did not pay invoice number 202574, the business can check the remittance advice and reply, "That invoice was included in the payment sent on that date." So, remittance advices support good record keeping. Computerized remittance advices. A computerized payables ledger system can produce remittance advices automatically. This is useful because the system already holds the invoice and payment details. When the payment is prepared, the system can also print or produce the remittance advice. In modern systems, remittance advices may be printed and posted, printed and sent with a check, emailed to the supplier, attached to an electronic payment notification. The format may change, but the purpose is the same. The purpose is to explain the payment. Now we are studying Lesson 3.5, Checks over Payments. In the previous lesson, we studied computer checks and remittance advices. We learned that a computerized system may prepare checks and remittance advices for supplier payments. Now we move to a very important control question. How does a business make sure that only correct and valid payments are made? This lesson is about checking payments before cash leaves the business. Main idea of Lesson 3.5. The main idea is simple. A business must have procedures to make sure that only valid payments are made. A valid payment means a payment that the business really should make. In simple words, before the business pays a supplier, it must check. Is the supplier real? Is the invoice genuine? Were the goods or services received? Is the amount correct? Has the invoice been approved? Has the payment been authorized? Has this invoice already been paid before? Is there any dispute with the supplier? These checks are important because supplier payments involve money leaving the business. Once the money has left, it may be difficult to recover it if the payment was wrong. Why checks over payments are important? Payments must be checked because many things can go wrong. For example, a business might pay the wrong supplier. A business might pay the wrong amount. A business might pay the same invoice twice. A business might pay an invoice before goods are received. A business might pay an invoice that is not authorized. A business might pay a fraudulent invoice. A business might pay an invoice that is still in dispute. So the purpose of checks over payments is to protect the business from error, fraud, and unnecessary loss of cash. Procedure 1. Authorization by an appropriate official. The first important procedure is authorization of payments by an appropriate official. Authorization means official approval. An appropriate official means a suitable senior person in the organization. This person may be a senior employee, a finance manager, a director, the general manager, another authorized person. The main point is, a junior clerk should not usually have full power to make supplier payments alone. Why? Because payments involve business cash, and cash must be protected. A senior person should approve payments before they are made. Why senior authorization matters? Senior authorization matters because the senior person has responsibility for protecting the business. The senior person should check whether the payment is reasonable and properly supported. For example, before approving a supplier payment, the senior person may ask, "Why are we paying this supplier? Is this invoice approved? Is the amount correct? Has the supplier balance been checked? Are there any unusual items? Is the payment due now?" This reduces the risk of wrong or unauthorized payments. Procedure 2. Checks, signed by authorized signatories. The second procedure is that checks should be signed by authorized check signatories. A check signatory is a person allowed to sign checks for the business. The bank keeps a record of the people who are authorized to sign checks. So, if a check is signed by an authorized signatory, the bank can pay it as requested. But if the check is signed by someone who is not authorized, the bank may reject it. This is a control procedure. It helps prevent unauthorized people from sending money out of the business. Important point about check signatures. Students, remember this carefully. The bank does not check every invoice behind the check. The bank mainly checks whether the check is properly signed and valid from the bank's point of view. So the business itself must check the invoice, goods received note, approval, and supplier balance. The bank checks the authority to pay. The business checks whether the payment should be made. Both are important, but they are not the same. Procedure 3. Password restrictions in computerized systems. In a computerized payables ledger system, checks or payments may be produced by the system. In that case, the system should have password restrictions. Password restrictions help control who can authorize payments. For example, a junior clerk may be allowed to prepare a payment list. A finance manager may be allowed to authorize medium-sized payments. A director may be required to authorize large payments. This means different users have different levels of authority. This is important because one person should not have unlimited power to make all payments. Why password restrictions are useful? Password restrictions help the business control risk. For example, if a payment is very small, the system may allow a normal authorized employee to process it. But if the payment is very large, the system may require approval from a higher level person. This protects the business from large unauthorized payments. It also creates a record of who approved the payment. That record is useful if there is a question later. Procedure 4. Supporting documents must be presented. The next important procedure is that supporting documents should be presented to the person authorizing the payment. Supporting documents are documents that prove the payment is valid. They may include the supplier invoice, the purchase order, the goods received note, the supplier statement, a credit note, a payment listing, an approval note from the department that requested the purchase. The person authorizing the payment should not approve blindly. They should see the evidence. What is the supplier invoice? A supplier invoice is a document from the supplier asking the business to pay. It usually shows the supplier's name, the invoice number, the date, the goods or services supplied, the amount payable, any tax, the payment terms. The invoice is important because it tells the business what the supplier is asking to be paid. What is the goods received note? A goods received note is a document showing that the business actually received the goods. This is very important. Why? Because the business should not pay for goods that were not received. For example, if the supplier sends an invoice for 10 boxes, but the business received only 8 boxes, the business should not simply pay the full invoice without investigation. The goods received note helps confirm what was actually received. Why supporting documents are checked. Supporting documents are checked to make sure the payment is genuine and correct. The person reviewing the payment should check. Does the invoice match the goods received note? Does the invoice match the purchase order? Was the invoice approved by the correct staff member? Is the amount reasonable? Is the supplier correct? Is the payment due? Are there any credit notes or discounts? Is there any sign that the invoice is unusual? This check helps the business avoid incorrect payments. Independent review. The textbook also explains an important control idea. The person reviewing the payment documents should be independent of the person who prepared or processed the documents. This means the same person should not do everything. For example, one person enters the invoice into the system. Another person prepares the payment list. A senior person reviews and authorizes the payment. This is called segregation of duties. Segregation of duties means dividing tasks between different people to reduce errors and fraud. Why independent review matters. Independent review matters because a fresh person may notice problems. For example, the person who entered the invoice may not notice that the supplier name is wrong, but the manager reviewing the documents may notice it. The person preparing the payment may not notice that a credit note is missing, but an independent reviewer may notice it. So, independent review improves control and accuracy. Unusual items must be investigated. The person reviewing the payment should look for unusual items. An unusual item is something that does not look normal. For example, a very large payment, a payment to a new supplier, a payment made outside the normal payment run, a duplicate invoice number, an invoice with no goods received note, a payment to a supplier with a disputed balance, a sudden change in supplier bank details, a payment that is earlier than expected. Unusual items should not be ignored. They should be investigated before payment is made. Automated payment methods. In large organizations, payments may be selected and processed automatically by computer. For example, the system may select all invoices that are due and produce payment instructions. This is efficient, but it creates a control issue. If the computer processes many payments automatically, there may not be the same individual check on every payment. So the business needs strong controls over the payables ledger. This means the business must make sure supplier balances, invoices, due dates, and approvals are correct before the automated payment process runs. Mechanical signatures and automatic payments. Some systems may use mechanical signatures or electronic approvals. A mechanical signature is a printed or automated signature used on checks or payment documents. This may save time in large businesses, but it can be risky if not controlled. The business must make sure that only authorized payments are included. Otherwise, the system may process wrong payments quickly and in large numbers. So, automated systems need strong authorization controls, password controls, and regular reviews. Special manual payments. Sometimes the normal payment method may need to be bypassed. To bypass means to go around the normal procedure. For example, the computer may usually select payments automatically, but one supplier may need an urgent special payment, or the normal payment amount may need to be changed, or a special manual payment may be required because of an emergency. In such cases, the business must be extra careful. Special manual payments should have proper checks and high-level authorization. Why special payments need high-level authorization? Special payments are risky because they do not follow the normal routine. For example, a fraudster may try to create urgency and say, "This payment must be made today." If the business rushes without checking, it may send money incorrectly. So, special payments should be approved by a high-level person. The business should still check the invoice, supplier details, amount, and reason for urgency. Urgent does not mean uncontrolled. Simple classroom example. Let us imagine a business called Bright Office Supplies. The accounts clerk prepares a payment to Paperworld for $1,000. Before the payment is made, the finance manager checks the documents. The manager checks the supplier invoice. The manager checks the goods received note. The manager checks that the department approved the purchase. The manager checks that the invoice has not already been paid. The manager checks that the supplier account balance is correct. Only after these checks does the manager authorize the payment. This is a good payment control system. Bad control example. Now imagine the same business has weak control. One clerk receives invoices, enters them into the system, prepares payments, approves payments, and sends money to suppliers. This is dangerous. Why? Because one person has too much control. They could make a mistake and no one might notice. They could pay the wrong supplier. They could pay a fake invoice. They could pay an invoice twice. They could even commit fraud. This is why checks over payments are necessary. Why this lesson matters. This lesson matters because payment control protects business cash. A business can survive many problems, but if cash is poorly controlled, the business may quickly face serious difficulty. Checks over payments help the business. Pay only genuine invoices. Avoid duplicate payments. Avoid paying disputed invoices. Avoid paying fake suppliers. Avoid paying before goods are received. Keep proper accounting records. Protect cash from fraud and error. Now we are starting Lesson 4, the age analysis of payables and other reports. In the earlier lessons, we learned how supplier accounts are recorded, checked, reconciled, and paid. Now we move to another important management question. How can the business use Payables Ledger reports to understand its supplier debts better? A business may have many suppliers. Some supplier balances may be new, some may be old, some may be overdue, some may be in dispute. So the business needs reports that help management understand who is owed money, how much is owed, how old the debt is, which supplier balances are overdue, which payments may need urgent attention, whether the business is delaying payments too long. One important report is called an age analysis of payables. Lesson 4, the age analysis of payables and other reports. A computerized payables ledger can produce different reports for management. These reports help the business control supplier accounts. The most important report in this lesson is the age analysis of payables. The word age here does not mean the age of the supplier. It means how long the supplier balance has been unpaid. So, an age analysis of payables shows the age profile of supplier debts. In simple words, it answers this question: how old are the amounts we still owe to suppliers? Why this is useful. A business needs to know whether supplier balances are being paid on time. If many balances are old, this may mean the business is delaying payments. That could be dangerous. Delayed payments may cause problems such as losing supplier goodwill, losing early payment discounts, damaging supplier relationships, being refused future credit, being asked to pay cash before delivery, interruptions in supply. So age analysis is not only an accounting report, it is also a business management tool. Lesson 4.1, the age analysis of payables. Now we study Lesson 4.1, the age analysis of payables. An age analysis of payables is a report that lists supplier balances and groups them by age. For example, the report may show amounts not yet due, amounts due within 1 month, amounts overdue by 1 month, amounts overdue by 2 months, amounts overdue by more than 2 months. The exact columns depend on the business system, but the purpose is the same, to show how old unpaid supplier balances are. Simple meaning. Let us make the meaning very simple. If a supplier invoice was received recently, it is a new payable. If the invoice has been unpaid for a long time, it is an old payable. The age analysis separates these balances into time groups. This helps management see whether the business is paying suppliers reasonably or whether it is falling behind. Example of an age analysis. Imagine a business has 3 supplier balances. Supplier A is owed $200 from an invoice received this week. Supplier B is owed $500 from an invoice received last month. Supplier C is owed $700 from an invoice received 3 months ago. The age analysis will show that supplier C is the oldest and may need attention. Why? Because a 3-month-old unpaid balance may be overdue. Management may ask, why has this supplier not been paid? Is there a dispute? Is the invoice missing approval? Is the business short of cash? Was the payment accidentally missed? Is there a credit note expected? This is the purpose of the age analysis. It highlights balances that need investigation. What the age analysis tells management. The age analysis of payables tells management about the age profile of supplier accounts. The age profile means the pattern of unpaid supplier balances by age. For example, management may see, most supplier balances are recent. Some balances are due soon. A few balances are long overdue. One supplier has not been paid for several months. This helps management understand how quickly the business is paying its debts. If most balances are very old, the business may have a payment problem. If most balances are recent, the business may be controlling payments well. Why long overdue payables matter. A long overdue payable is a supplier balance that has not been paid after the expected time. Long overdue supplier balances matter because they can damage the business. For example, a supplier may think, "This business is not paying us on time." Then the supplier may take action. The supplier may stop supplying goods. The supplier may refuse further credit. The supplier may demand payment before delivery. The supplier may remove discounts. The supplier may charge interest or penalties. The supplier may reduce trust in the business. So, overdue payables are not just numbers in a report. They can affect the real operation of the business. How management uses the report. Management may use the age analysis to ask the accounts department questions. For example, why is this balance overdue? Has the invoice been approved? Is there a dispute with the supplier? Has the supplier sent a correct statement? Was the payment missed? Is the business deliberately delaying payment to preserve cash? Will late payment damage the supplier relationship? This helps management control the payables ledger and make better payment decisions. Link with cash flow. Age analysis of payables is also connected with cash flow. Cash flow means the movement of money into and out of the business. If the business delays payments, it keeps cash inside the business for longer. This may help short-term cash flow. But delaying payments too long can cause problems. The business must balance two ideas. It should use supplier credit sensibly. It should not delay payments so long that it damages relationships or loses benefits. So, age analysis helps management understand whether payment delays are reasonable or risky. Why age analysis of payables is different from age analysis of receivables. Students, this is a very important exam point. In Chapter 13, you studied age analysis of receivables. Receivables are customers who owe money to the business. Payables are suppliers whom the business owes money to. An age analysis of receivables is extremely important because the business needs to collect money from customers. It helps with credit control. An age analysis of payables is also useful, but it may not be as important as receivables age analysis. Why? Because receivables age analysis helps the business collect cash from customers. Payables age analysis helps the business monitor how it is paying suppliers. Both are useful, but receivables age analysis is often more critical for cash collection. Significance of an age analysis of payables. The significance means the importance of the report. An age analysis of payables may show that the business is delaying payment of suppliers. This may be done to keep cash in the business for longer, but delaying payments may create negative consequences. The business may lose settlement discounts. The business may lose supplier goodwill. The business may lose the ability to buy goods or services on credit. Let us explain these one by one. Losing discounts. Some suppliers offer discounts if the business pays early. If the business delays payment too long, it may lose the discount. For example, the supplier may say, "If you pay within 10 days, you can deduct 2%. If the business pays after the discount period, it must pay the full amount. So, delaying payment may cost the business money. Losing supplier goodwill. Goodwill here means the good relationship and trust between the business and the supplier. If the business regularly pays late, suppliers may become unhappy. They may feel that the business is unreliable. This can damage the relationship. Good suppliers are valuable, so the business should protect those relationships. Losing credit facilities. A credit facility means the supplier allows the business to buy now and pay later. If the business pays too late, the supplier may stop offering credit. The supplier may say, "From now on, you must pay cash before delivery." This can create serious cash flow and operational problems. For example, if a bakery loses credit from its flour supplier, it may have to pay cash before receiving flour. That could make daily operations more difficult. Now we are studying Lesson 4.2, Other Reports. In Lesson 4.1, we studied the age analysis of payables. That report shows how old supplier balances are. Now we move to a wider question. What other reports can a computerized payables ledger produce? A computerized payables ledger can produce many useful reports for management, accountants, and control purposes. These reports help the business understand supplier accounts, payments, purchases, tax, and balances more clearly. Main idea of Lesson 4.2. A computerized payables ledger system does not only record supplier transactions, it can also print or produce useful reports. These reports are similar to the reports produced by a receivables ledger system. Remember the difference. A receivables ledger gives information about customers who owe money to the business. A payables ledger gives information about suppliers whom the business owes money to. So the reporting idea is similar, but the direction is different. Receivables reports help the business control customers. Payables reports help the business control suppliers. Why other payables reports are useful? Other payables reports are useful because a business may have many suppliers. The business needs to know who the suppliers are, where the suppliers are located, what transactions have been recorded, how much is owed to each supplier, which payments have been made, which purchases were made, what tax amounts are involved, which supplier accounts exist in the system. Without good reports, supplier control becomes difficult. The business may miss payments, pay the wrong supplier, lose discounts, or keep inaccurate records. Report 1. Mailing list of suppliers' names and addresses. The first report is a mailing list of suppliers' names and addresses. This report shows supplier contact details. It may include supplier name, supplier address, telephone number, email address, account reference, contact person. This report is useful when the business needs to contact suppliers. For example, the business may use it to send letters, remittance advices, payment information, or account queries. In simple words, this report helps the business know who the supplier is and how to contact them. Report 2. Supplier account statement of transactions and current balance. The second report is a supplier account statement of transactions and current balance. This report shows the activity on one supplier's account. It may include opening balance, invoices received, credit notes received, payments made, discounts received, closing balance. The current balance means the amount currently owed to the supplier. This report is useful when the business wants to check one supplier account in detail. For example, if a supplier says, "You still owe us money," the business can print the supplier account statement and check which invoices are unpaid, which payments have been made, which credit notes have been recorded, whether the balance is correct. This report supports supplier reconciliation and payment control. Report 3. Remittance advices. The third report is remittance advices. We studied this in lesson 3.4. A remittance advice is a document sent to the supplier to explain what a payment is for. It may show the supplier name, the payment date, the invoice numbers being paid, the credit notes deducted, the discounts taken, the final payment amount. This helps the supplier record the payment correctly. Remember the key difference. A payment sends money. A remittance advice explains the payment. So a computerized payables ledger can produce remittance advices automatically when supplier payments are made. Report 4. Sales tax analysis. The fourth report is a sales tax analysis. Even though the business is dealing with suppliers, sales tax may still be involved in purchase invoices. For example, in Canada, this may involve GST or HST. In other countries, it may be called VAT or sales tax. When the business receives supplier invoices, the invoices may include tax. The payables ledger system can produce a report showing tax amounts recorded on supplier transactions. This is useful because the business may need to prepare tax returns or check tax records. In simple words, a sales tax analysis helps the business check the tax connected with purchases and supplier invoices. Report 5. Purchases analysis. The fifth report is a purchases analysis. A purchases analysis shows information about what the business has purchased. It may classify purchases by type, supplier, department, or expense category. For example, it may show purchases of raw materials, purchases of office supplies, purchases of packaging, purchases of repairs, purchases from a particular supplier, purchases for a particular department. This report helps management understand spending. For example, management may ask, how much did we spend on materials this month? Which supplier did we buy from most often? Which department is spending the most? Are purchases increasing? Are any costs unusual? So, purchases analysis helps the business control costs. Report 6. List of supplier accounts. The sixth report is a list of supplier accounts. This report shows the supplier accounts that exist in the payables ledger. It may include supplier account codes, supplier names, current balances, account status, contact details. This is useful because the business needs a clear list of suppliers in the system. For example, management may want to check which suppliers are active, which suppliers have balances, which accounts are no longer used, whether duplicate supplier accounts exist, whether any supplier account needs updating. This helps keep the payables ledger organized. Password restriction and access control. The textbook also gives an important control point. Access to payables ledger reports is normally restricted by password. This is very important. Why? Because payables ledger reports may contain sensitive information. They may show supplier names, supplier addresses, amounts owed, payment details, purchase information, tax information, business spending patterns. Not every employee should be able to see or print these reports. So, the business should restrict access. Only authorized staff should be able to view, print, or change payables ledger reports. Why password control matters. Password control protects the business. For example, if anyone could access supplier reports, someone might misuse supplier information. They might change supplier details. They might see confidential payment information. They might create a fake supplier account. They might interfere with payment records. They might print sensitive reports without permission. So, password control helps protect supplier data and business cash. Simple classroom example. Let us imagine a business called Bright Office Supplies. Bright Office Supplies uses a computerized payables ledger. At the end of the month, the accountant may produce different reports. A supplier mailing list to update supplier contact details. A supplier account statement to check the balance owed to Paperworld. A remittance advice to explain a payment sent to city computers. A sales tax analysis to check tax recorded on supplier invoices. A purchases analysis to see how much was spent on office supplies. A list of supplier accounts to check all supplier accounts in the system. Each report helps the business control a different part of the payables ledger.